Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That is Diane King Hall. Brad Smith is off today. Here are three things you need to know this morning. Tesla shares slump after a disappointing earnings call, hinting at further price cuts and higher spending in the months ahead. Margins below expectations were the big concern, with operating income of $2.4 billion missing the street by a distance. CEO Elon Musk says Tesla will have to keep dropping prices if rates continue to rise. This as he confirmed that third quarter production will slow amid factory upgrades. Investors hoping for a detailed roadmap, meanwhile, on the Cybertruck. They didn't get one. They'll also have been struck by Musk's comments on the Dojo supercomputer. It's going to cost over $1 billion by the end of 2024. And Netflix shares also slumped as its third quarter revenue forecast disappoints despite a crackdown on password sharing that boosted subscribers. Netflix grew its sub base by 8%. That's way ahead of expectations, though its average revenue per member fell 3% from a year earlier due to regional pricing differences. Sales underwhelmed, with growth of just 2.7% to about $8.2 billion in the second quarter. Evercore's Mark Mahaney says the fundamental story is getting stronger, not weaker. We're going to speak with him in just a few. And American Airlines shares slumped despite raising its full-year profit forecast. Adjusted earnings per share coming in at $1.92 versus the $1.59 that was expected. Revenue also comfortably beating at just over $14 billion. American says it's almost two-thirds of the way to its goal of reducing its debt by $15 billion by the end of 2025. The report comes hot off the heels of United, which posted record quarterly earnings with a bullish forecast for the third quarter. And last week, Delta raised its forecast for full-year earnings.
Well, from the skies to the ground, Elon Musk disappointing investors on Tesla's earnings call, sending shares of the company lower this morning, down 4%. Musk warning that vehicle production will slow during the third quarter and noting that Tesla will continue cutting prices if rates continue to rise. He did not hesitate to blame the global economy and macro conditions for just about everything. Here's a glimpse of what he had to say.
And if somebody's got a crystal ball for the global economy, I really appreciate it if I could borrow that crystal ball. DM us. Yeah, exactly. DM me on Twitter. It should be a note on Twitter. I mean, one day it seems like the world economy is falling apart, and the next day everything's fine. I don't know what the hell's going on. To be totally frank.
Very Musk-like comments there. Yahoo Finance's Pras Subramanian was intently listening, as many of us were, and he joins us now alongside, of course, Steve Sosnick, Interactive Brokers Chief Market Strategist, for this very exciting edition of After the Call. All right, Pras, let's get into it. What's your top takeaway?
What the hell is going on, in the words of Musk?
To quote Elon Musk.
I'm going to try to verbalize my answer like he mumbling and stumbling. Let's see. So, yeah, a lot going on in that call, right? We had the strong headline numbers after the bell, but then Musk immediately sort of knocking the stock with this Q3 production warning, which sort of caught people off guard. A lot of investors were commenting on that. But then riffing on a number of topics we'll get into. First off, the big focus on margins, of course. Everyone focused on, is this the margin trough? Is this where we're at? You know, they disappointed with that 18.2% overall gross margin there. So there's some talk about that was disappointing, but also, hey, the automotive gross margins actually were better than expected. So here's what Musk had to say, sort of batting away a lot of these issues on what people want to hear on margins.
Oh, man. Where's that crystal ball again? if I may, it's like, look, the short-term variances in gross margin and profitability really are minor relative to the long-term picture. Autonomy will make all of these numbers look silly.
Yeah, I mean, talking about autonomy, saying that it had like an unlimited gross margin, like 100%. So, he just sort of was like not willing to talk about those particular issues. But, a number of these came up, of course, FSD and charging. So we can talk about that. But yeah, that was a big takeaway, was what he said about gross margins.
Before we get to some of the other issues, I want to zero in on FSD for a minute. Full self-driving, in other words, which is not really full self-driving, but that's, not yet.
That's the intent.
That's what they're calling it. But you still got to sit behind the wheel of your car. So he mentioned on the call, he teased out that they are having discussions with a major automaker to license that software. So when he says full autonomy is the thing, that's what he's talking about.
Yeah, that would be.
Just to make clear.
Exactly, like white labeling that product, just infinite amount of money from a licensing point of view, because you're already putting in that fixed cost to develop the product. He said that they had, it's not news that he was wanting to license the product. It was news that he said a major OEM was in initial discussion. So that was a big deal. People are sort of speculating on who that could be. Hint, hint, maybe it's his first charging partner. I don't know. We'll see. I'm not saying anything about that. But so that was one thing. Also, the Cybertruck came up a lot. People asking about that timeline. Like you said, still a bit vague, but they did say that they would deliver initial cars this year. The production was going to start this year. Tooling has begun at the factory, so it is on track. And then he said high volume production in next year. So here's what he had to say about that Cybertruck and also the demand story for that truck.
The demand is so far off the hook you can't even see the hook. So that's really not an issue. I do want to emphasize that the Cybertruck has a lot of new technology in it, like a lot. It doesn't look like any other vehicle because it is not like any other vehicle. And the production ramp will move as fast as the slowest and least likely element of the entire supply chain and internal production.
I think when he says production ramp, everyone sort of thinks that, Elon, you've said this before about many products that have taken years to come out. Are you really going to hit that end of year goal? It seems like they're on track. They showed that one vehicle at the factory that rolled off.
But we all thought that one vehicle was the beginning of the production, and apparently it wasn't. That was just like a demo vehicle,
I think it was they call it a release candidate. It's like like they roll off the line. They got to make sure the factory line's working. They didn't really get into that much, to be honest with you. So that's what I'm speculating when they said release candidate. So you're right. I mean, we don't know if that line is fully operational. So who knows?
Steve wants to jump in on this.
Go
ahead.
One question that I had was, one of the reason for the earnings beat was $400 million in other income. What was the other income from? Did you get a good handle on it? Because I did not.
It's funny. I think that was worth, 9 cents of EPS?
Yeah.
So it would have been a miss if not for that. I'm not sure what that is.
I know, especially
they break out solar and they break out the other businesses. I heard it might have been a currency gain, that they actually had an FX positive outcome on some currency they held, and that could have been this 9 cent.
Isn't that a problem though, when a guy who covers the company this closely and a guy who tracks the company this closely, like Tesla, a company of that size, don't they need to be a little more transparent about what that is?
And they're basically like saying on that call, trust us, don't worry. Like, even though he says he has no crystal ball a couple of times, he makes some bold statements saying, he doesn't land on a specific date on the Cybertruck, and says basically it doesn't matter, and that Tesla is an epic long-term investment, quote.
Well, it's worked out so well so far for people who have invested in it. Okay, so let's get our sort of vibe checks from the call. Steve, I'll go to you first on that.
The vibe check is, I've been referring to Tesla as a faith-based stock for years.
Right, so that's exactly what you're saying.
That fits in completely with what you said, Dan. And he needs to keep the faithful in line. But Julie, as you said, the faithful have been rewarded. But you always need to have some sort of shiny object out there. And, Cybertruck, the Dojo computer. To me, the long and the short of it is, if they reinvent themselves as a software company, FSD, autonomy, whatever you want to call it, well, then you might be able to support the kind of enthusiasm that's priced into the stock, the 85 PE, the PEG ratio of 5, the fact that earnings haven't really grown for a growth company, then maybe down the road you can support all this. But that to me is why he has to keep harping on that, because making cars is not bending metal is not a particularly profitable business. It's good, it works for them, but not super well.
Well, I think that, like you mentioned, Praz, earlier, the big bet for them now, it seems like, is this focus on the software. He really seemed to hone in on that in the call, the FSD and the licensing, as you mentioned, and he talked about a big in talks with a major OEM about this. I don't know if you have any whispers about which one it is. If it may be one of the ones they've tied up with regard to the supercharging network, the North American standard now. Right. It's possible, since they already have an established base. And one thing he says he loves the small shareholder, the ones who stuck beside him through thin and thin. Does that even matter? Does it matter?
It does for Tesla. Tesla. It is by far the number one most active stock on our platform, always, perpetually, like number one with a bullet. I did a little math yesterday. I think $30 trillion worth of Tesla stock has turned over this year. That's like, I think Microsoft, which is probably a similarly interesting candidate, was a fraction of that, maybe 20%, 15%. I don't have the numbers in front of me, but yeah, the small investors are the ones who prop up this valuation. Because they are, going back to the faith analogy, they're the flock.
Yeah. So your
gospel of Elon.
So your vibe check was good, bad, and ugly, I guess, depending on who you are, right? Like listening, it's in the eye of the beholder. What's your vibe check from the call?
I mean, I think Steve has the correct take here. I was going to go with mad, but I think you're absolutely right. I think it's good, bad, and ugly for a number of reasons. But for instance, the ugly bad could be the avoidance of the gross margin discussions. The meh could be Cybertruck is on track. And the good could be, hey, the FSD licensing discussion is going on. Steve, I got to follow up on this $30 trillion the trading of Tesla stock on the platform. I mean, is a lot of the valuation propping because of the fact that it's such a liquid stock? Like, are we giving it a premium because of liquidity?
Absolutely. I think it does get that. The options are also, that didn't even include the amount of options that trade. And of course, when the options trade, it drives the stock. It's one big ecosystem. So that definitely it plays into it. That's also to some extent why it sank so fast and so hard in November and December, because we had tax loss selling, and that metastasized into something worse as well. So yeah, I mean as this discussion shows, everything Tesla gets magnified. It's polarizing. It's the fifth largest company by market cap, but it is by far the number one in terms of mind space.
Yeah, I'm sure Elon likes it that way. Pross, thank you so much. Steve's going to stick with us, and we are going to check in with an analyst in the next hour to talk more Tesla. Can't get enough. But we also can't get enough of this next one. Netflix shares are sinking this morning despite signs that its ongoing effort to crack down on password sharing is paying off. The streaming giant adding 5.9 million new subscribers in the second quarter. That's a lot better than estimated. But that growth was not enough to distract investors from the company's revenue miss or weaker than expected forecast. Mark Mahaney, Evercore ISI Senior Managing Director and Head of Internet Research, joins us now. Steve Sosnick, Interactive Brokers Chief Strategist, is still with us as well. Mark, such an interesting story here. Also interesting that they raised that free cash flow forecast for the year because of the strikes. They're not going to be spending as much money on programming, but one would think eventually they'll spend it. But give us your sort of big picture take, though, on Netflix to kick us off.
Well, we had an expectations correction, and that's what's going through the stock now. I think it was down as much as 8 or 9%. It's down 6%. But expectations were super high. I think of all the companies I look at, if I include Amazon or Google or Meta, this had the highest expectations, and they were well above where the street numbers were. I think the buy side was looking for materially higher sub numbers. They were met in the June quarter, but they weren't in terms of the guide, and revenue came in a little light. And so for a stock that's had such a huge run, you're going to have these kind of corrections. Then the open question is it a fundamentals correction or an expectations correction? In other words, are fundamentals getting weaker? I think they're getting stronger. The one issue that we all need to really resolve if you want to buy the stock is, do you believe that ARPU, revenue per user, is going to continue to rise? I think it will. It's just a matter, I think it's going to be a long runway of growth. I think you're going to see acceleration for a year or two in that key metric. Password sharing is working, and it's showing up in the numbers. And the ad-supported business really is not yet working. At least it's not showing up in the numbers, but I'm pretty sure it will. And so you still got these nice two growth drivers of what I call growth curve initiatives. I like the stock, and you can buy it at a reasonable gap PE multiple. So it's still long for us. 550 is what we think it goes to.
So, Mark, where it is with the password sharing crackdown, are you satisfied with that? And then how long do we expect that to take, and where it could, potentially even impact the numbers in a negative way?
I think we're beyond the point where it's going to negatively impact the numbers. It's possible. When they first rolled it out in Canada earlier this year, there was tentative evidence that it was causing a spike in churn. That's what caused a real correction in Netflix shares earlier. But then they got through that. And what happens with the password sharing rollout is, first, there's a little bit of a negative reaction because it's kind of perceived correctly as a price increase. The Mahaney household, our Netflix budget is going up because I've got kids at college who've been using my account. So that is perceived as a price increase. But what seems to be happening is that churn to increase time is actually shrunk really quickly. Like a lot of people are agreeing and signing up for their own independent accounts. And by the way, it helps that you have this $6.99 offering. That's pretty inexpensive. In fact, it's downright cheap for a month of Netflix entertainment. So I think what you're going to have is, you ask how long this will take to really build up. Our guess is that if there were 100 million borrowing households, maybe about a third of them will probably either get their own account or will be paid for by their host account. And we'll have that number. It'll probably be fully fleshed out in kind of the next 3 or 4 quarters.
You know, it's funny. My Netflix spending has gone up for the same reason. My wife buckled and bought the kids the cheaper accounts, which I think, correct me if I'm wrong, I think that had a lot to do with the subscriber growth, but there were lower margin subscribers because there were add-ons to the household. But the question that I'm wrestling with is, how will the strike affect them? I can come up with a scenario where it helps them. Obviously, they said it'll improve their cash flow. And I could also come up with a scenario where it's really helpful in the sense that, all right, there's nothing new coming out, so I'll go back and binge stuff on Netflix. The flip side is they don't have any new content either. Where do you fall on that?
Well, I think the longer the strike, the worse it is for all of the studios, and worse it is for Netflix. I mean, they may have a near-term buffer in that they tend to produce shows well in advance of when they were released. So their content slate between now and the end of the year, their release slate, that's pretty much all in post-production phase anyway. So the writers and the actor strike doesn't impact that. But it's going to impact the slate that was expected to come out in the first half of next year. So that's, so it is an issue. It's an issue for all of them. And there may be a small near-term competitive advantage for Netflix, but long-term, it's something that they need to get resolved, for Netflix not to have a hole in the content, in its content rollout. In order not to have that hole, they need to get this resolved, I'd say, in the next quarter. So it's just not good for anybody involved, I don't believe.
So, yeah, Mark, I want to talk a little bit more about that strike. The writer strike has been ongoing. The SAG strike is at the front end. The last time you had strikes of this capacity, when we're going back to the 80s or 2000, you had 3 to 6 months. If this is a 6-month strike, if it's even longer, how well is Netflix positioned in terms of its content to be able to just sustain the platform and sustain, continued revenue growth?
Yeah, it's not insulated. I know there was some discussion about how much of their content is generated overseas, and there's no question, like some of these shows like Squid Games that are just monster hits for the company, that's all outside of the U.S. And I don't think the writers of the Screen Actors Guild strike would impact their ability to roll out the next season. The next season of Squid Games, but still, there is a large amount of content on their slate that's going to be negatively impacted if the writer's strike continues. So, yeah, it's an issue again for all of the studios. And it's an issue for Netflix. It is interesting just how dramatically entertainment has changed since the last major strike. I mean, streaming wasn't even in a gleam in the eye back then, and now. Netflix is, fighting with YouTube to be the single largest screen time, really of all studios. So, congrats to Netflix on what they've done over the last 20 years. But they need to resolve, and as the other studios do, they need to resolve the strike.
Yeah, whereas YouTube, it's not so reliant on that that kind of produced content. Mark, you mentioned at the beginning that expectations were super high going into Netflix, and you mentioned some of the other companies you cover. I am curious, since this is just the leading edge of all of those companies, what your top pick is going into these earnings that you cover.
Well, so our top pick is Uber, second pick is Amazon, third pick is Meta. And we think with Uber, we got a couple of value catalysts coming up. This company finally hit positive free cash flow last year. This year, we think in the back half of the year, they'll start hitting positive GAAP earnings profitability. And then I think they're going to start buying back stock, and I think they'll then be in that kind of club that could be included in the S&P 500. So you got kind of 3 value catalysts. Amazon, I think, is at an inflection in terms of AWS cloud computing growth in the back half of the year, and they should be a good derivative off of all these AI workloads. And then Meta, I know it's had a monster run year to date, kind of like Netflix, but Meta trades still at 17 times earnings. It's still, I think, the cheapest of the high-quality tech names out there. So, yes, it's still a long first. It's a third pick.
All right, Mark Mahaney, Evercore ISI Senior Managing Director and Head of Internet Research. Thank you so much. Steve Sosnick, you stay with us. All right, switching gears. American Airlines shares slumping despite boosting its full-year profit forecast as the tailwind for the big carriers continues. Adjusted EPS for American came in at $1.92 versus the $1.59 expected, so that was actually beat. Revenue also comfortably beating at just over $14 billion. American says it's almost two-thirds of the way to its goal of reducing its debt by $15 billion by the end of 2025. That report, of course, comes hot off the heels of United Airlines. It posted record quarterly earnings with a bullish forecast for the third quarter. Then you had last week Delta raising its profit forecast for full year earnings. So when we take a look at just all these airlines, you wonder if just some of the, especially for American, the expectations going into it, like it just had a lot of runway. And also, of course, the case for the stock, you know, there may be some profit taking coming into this, right, Steve?
Well, this is characteristic of it. It goes into what Mark said about expectations being a little high for Netflix. They're high for American. I mean, I don't know if you've tried to fly this summer. I have, and
I'm about to.
It's not pleasant. I just booked a flight on American, by the way, recently, and so I'm gonna, you know, I'll know if I see you in LaGuardia.
Yeah,
but I mean,
I will be in LaGuardia on Saturday, so maybe we'll see each other.
Not quite so quickly,
okay.
but you know, this is a story everybody's known now. Is the airlines, you know, people are traveling, the airlines are doing better. This is a much better environment for them. They're getting their balance sheets in order, but you know, this is the problem. You know, going into earnings season is, have we set the bar too high? Mm-hmm. And so, you know, if everybody's expecting good news, you really have to come up with something spectacular to justify it. And that's kind of, at least so far, non-financially, that seems to be one of the themes early on. It's too early to really read it.
Well, and listen, we all like to talk about traveling. We all like to talk about airlines. In terms of an investable case, they're just not as heavily traded. Like when we talk about a Tesla, obviously Tesla blows everything else away. Airlines are super cyclical. Yep. They don't sort of keep to their capacity discipline over long swaths of time. You get people, remember when Warren Buffett was interested in airlines and like
I do remember
in a blip
that.
there?
Yeah. But do you remember what he said? He said the fastest way to become a millionaire is be a billionaire and buy an airline.
Yes.
So, and then also you look at American year to date, I mean, it's up 46%. So even today's, you know, move heading into the open is a blip to use your, you know.
Right. I mean, so like just to put it in perspective, when you were talking about Tesla on your platform, like what about the airlines?
They don't register really.
Exactly what you
no,
said.
that fits with what you're saying.
Yeah.
You know, that's not where people are thinking. Mm-hmm. It doesn't mean that there isn't a real institutional case for or against them, and that there aren't serious investors looking at them. But in terms of the average investor, it's just you know, every so often you get them. You know, they come to the fore, and they're kind of fading now because the story's out there.
Right. Right. Let's talk about another story that's sort of on a related note because it also affects travel, but it affects a lot more than that. I'm talking about the heat wave and other sort of weather changes here. Americans across the Southwest right now are battling brutal heat waves, and the cost of keeping cool is still hot. Even with falling inflation, electricity prices remain elevated. They're up 5.4% year over year with more extreme heat on the horizon. How are heat waves going to hit the economy? Steve, you know, we have the heat issue, we have the rain and the flooding issue, which has been affecting people here in the Northeast. As an investor, how do you think about this stuff?
The thing that I'm trying to grapple with, and I don't have the hard statistics for it, is if I'm running my air conditioner in Arizona, in Texas, in Southern California, in Florida, 24/7 at a rate that I've never had to run it before. It's, you know, when it's 95 degrees at midnight. So those air conditioners are going 24/7. So so the inflation rate on utilities might be 0.9%, but the amount of money that people are spending on utilities in a large swath of the country is enormous, and that money has to come from somewhere. If you have a fixed budget and you're spending more of it to just keep the house cool so that you don't, you know, to survive, that money is money's not going to be spent on other things. And I ran this by a friend of mine who lives in Houston, and she basically said, and I don't go anywhere anymore because it's just too hot. So I'm not going to restaurants. I'm not hungry because it's 100 degrees all the time. So I think this is one of these factors. It's very hard to quantify. I actually literally put on Twitter yesterday, does anyone have statistics on this? And I, crickets, because I don't know that it's really been quantified yet. But my gut tells me this is not good.
Yeah, and I mean, especially when you think of just the impact to the power grid across the country, and we've certainly seen places like Texas, when it's strained, how much that can affect both the local economy there and then just the infrastructure across the U.S. And I mean, and to your point just about how much we're running our air conditioners now. I mean, I find myself, we've been in 90-degree weather for like a few weeks now.
Yep.
I feel like,
And there's a lot of talk about student debt, and you and I actually talked about this recently offline. The idea that if you're spending the money now to pay down the debt, you're not spending it on other things. Less attention has been paid to if you're spending more money on your electric bill, you're not spending it on different things. We're talking to Torsten Slok in the next hour of Apollo. I have a feeling he has a view on this. I'm looking forward. I'm going to ask him about this, given this conversation.
Yes.
Yeah. So, but do you make any kind of investment decisions yet based on these kinds of sort of conjectures at this point?
I think right now you have to be a little bit concerned about what the consumer's doing. Discover, which is down.
Yes.
Last I looked was down about 12% this morning.
Mm-hmm.
So initially I want to hear from Visa. I want to hear from MasterCard. I want to hear where are people having to borrow on their credit cards to finance their lifestyle, or are they just cutting back overall on discretionary stuff because you have to spend it on necessities.
Right.
So that will be an interesting one. The problem is in many cases the retailers, Amazon excluded, the big retailers don't really start to come out until a month later. Their fiscal year is 1 month separate, 1 month later. And so it'll be very interesting to hear what a Walmart has to say, whether Dollar Tree is picking up shoppers or that kind of stuff.
Well, there was some news out from Walmart today about cutting the prices for a certain segment of its Walmart Plus membership for a certain segment of its
for people on food stamps and who get government aid, right?
Yeah.
Random question: bringing together our travel and our heat segments. Does everybody do this when you go on vacation? You turn your thermostat up so you don't have to pay for it while you're gone?
Coming back? I don't. I just turn my AC off. When I'm
turn it
gone.
off entirely?
Yes, when I'm gone. If I'm going to be gone for
right,
like a week or something. Yes.
If I'm going to be gone for an extended period of time, it goes off. If it's a couple days, it goes up to like 79 or 80 or 81 or something like that, just so that. If it's predicted to be really hot, so I don't walk into a house that's
and
like
you're
a sauna.
not immediately exactly.
But yes, it's a combination. Yes, I turn it up when I leave because what do I want? It's wasteful.
I don't want that.
Exactly, especially now if rates are going up and the heat is up. All right, Steve. Thank you. Great to spend so much time with you. This was fun.
Thank you.
We'll have you back to talk more earnings next time. Steve Sosnick, Interactive Brokers Chief Strategist. All right, we got much more markets action coming up ahead and the opening bell. Stay tuned. You're watching Yahoo Finance. What about surprises during the earnings season? Any early surprises thus far? And are there any other surprises you're looking for? Although I guess if you're looking for them, they're not as much surprises.
That's true. I would say the early read on the financials has been healthier than most people expected. There's certainly been deposit runoff, credit has been a challenge, and investment banking has been a challenge for some of the larger firms, but overall they've beat expectations more than most people expected.
All right, we just had the opening bell on Wall Street. We want to do a quick check of the market sponsored by Tasty Trade. We have a mixed open. Dow on the plus side, Nasdaq and S&P 500 under a little bit of pressure this morning, mild pressure. Let's get right over to Julie at the Wi-Fi Interactive.
Yeah, let's talk about what's going on here. And a lot of it now, we kind of switch over from the macro drivers of the market by and large, but of course we do have the Fed next week. But now sort of switching over to those individual company stocks driving the action that we see. So on that front, let's take a look at the trending tickers on the Yahoo Finance platform because, as you might imagine, a lot of them have to do with what's going on the earnings front. So Tesla, for example, which we talked about at length earlier, down 4.5% out of the gate here this morning. Taiwan Semiconductor, which we're going to talk more about in a moment, is trading down as well. On the plus side, and something that's probably helping the Dow a little bit here, shares of IBM up 1.8%. Initially, we saw a negative reaction for that stock. Now the shares are going up after its earnings after the close yesterday. Freeport-McMoRan, the big metals producer, up 2.5% on earnings as well. So you see that mixed picture being reflected in what's happening on the index level as well. Here are the sectors here. Energy is actually up the most today, followed by healthcare as we got the likes of J&J and some others reporting earnings. And you've got consumer discretionary and real estate that are doing the worst in today's session. So interesting here. Even among the sectors, it is quite mixed here today with pretty divergent moves. Getting on over to the Nasdaq 100 because there, of course, we have some of the biggest movers and earnings stories that we are watching. Of course, Tesla in dark red there on that screen, but a lot of the other companies that have reported earnings and now are being anticipated to report earnings are on that list. And a quick check on the banks. Actually, let me go to the regional screen because we have a number of the regionals that are still reporting here. Truist reporting this morning. Those shares are down by 6% in the wake of those numbers. Fifth Third as well. Those shares, though, up about 2%, almost 2%. And Zion reporting after the close, those shares up 7% as well. This one of the companies that saw some deposit growth. So just like we are seeing a mixed picture, I guess mixed picture is kind of the theme everywhere we're looking here this morning, Diane, even within some of the sectors.
When we go from broad to narrow, it is indeed. And I always like hearing about Fifth Third because, you know, I'm from Ohio, so it's a hometown bank.
Yeah, there you go.
All right, I want to get back to one that you talked about in particular, shares of Taiwan Semiconductor, that's TSMC. They're down this morning, down a little over 4% after profit fell 10% from a year ago. Now, this is the world's largest chip maker's first drop in profit in 4 years. So, you know, you saw this slump in demand for electronic devices that dinged the company. We know that it makes these processors in iPhones. It does some AMD processing stuff. You also I want to note rather that this knock that you're seeing on its share price, you're also seeing spill over to Intel a little bit as well. So, you know, that's one that, and Dan talked a little bit about this when we chatted with him yesterday.
Right.
That slowdown in smartphone growth and how it is still dinging these companies.
Right. Well, so just to remind viewers of the sort of stack within chip makers, right? Taiwan Semiconductor is actually physically making the chips, right? A company like NVIDIA largely designs the chips, and then Taiwan Semi makes the chips for them. That's mostly how it works. Intel is both. Well, it's kind of trying to get back to being a so-called foundry, actually making the chips and also designing them. But that's sort of how the separation works when it comes to Taiwan Semi. So it makes chips for NVIDIA. It also makes chips for, to your point, smartphones. And there's a balance right now, right? Because demand for AI chips is ramping up.
It's not there yet, though.
But demand for smartphone chips, for PC chips, is going down. And Wells Fargo analysts pointing this out, saying AI demand is, quote, not enough to offset other weakness across all other segments. Most of the analysts did expect this downgrade to demand. This is the third time this year that the company has cut its forecast. But it's just the depth of it, the size of it, that was a bit surprising.
It's true. And even TSMC's chairman, Mark Liu, said that the frenzy about the AI demand cannot extrapolate for the long term. This is a quote. He said, neither can we predict the near future, meaning next year even, how the sudden demand will continue or flatten out. So just kind of throwing water on the case right now. the getting into this stock, the case for getting into it right now. Maybe it's, next year kind of thing. And, even their CapEx forecast, they reiterated it, but towards the lower end of the range to between 32 and 36 billion. So that'll certainly be one we're watching. We are watching it today. All right, another one that we're watching, shares in drug maker Catalent jumping this morning. This is on a report from the Wall Street Journal. The activist investor Elliott has built a significant stake in the business. Now, Catalent manufactures drugs, vaccines, and gene therapies, has a market cap of 8.3 billion, a little over that. Now, the report says the exact size of the stake is still unclear, but is certainly helping the share price right now.
Yeah, it is.
5%.
While we're talking about companies that make stuff for other companies, that's
Right.
what Catalent does, right? They make drugs for other companies. They've made COVID-19 drugs, for example, but they have had some issues here. There's been some questions about quality control at the company. There's been chatter about whether it would be a takeover candidate. The company's CFO, I believe, left the company. They did find a replacement for that person. The CEO has only been there a little over a year. So there's a lot of sort of moving parts amidst Elliott swooping in here to try to push for some changes.
Yeah, and apparently they, delayed earnings a few times. So they're dealing with a lot of issues behind the scenes. But Elliott getting into this is certainly helping give Catalent just some support.
Yeah, and we should mention, that's right, we said the Wall Street Journal is reporting this, so they're giving a lot of the background on what's going on here. When they did finally come out with revenue, by the way, or for their numbers in June, they said revenue fell by 19% for the prior quarter. So they delayed it, and then it wasn't great.
Yeah, and we'll see what happens with Elliott getting in there.
We will. We'll look for more
sales
details on that.
Yeah.
Right. Sticking with healthcare, we have a lot of other movers to watch here, including Johnson & Johnson. Another reason that the Dow is likely outperforming today, these shares are up 4%. The healthcare giant seeing sales overall rise 6.3% in the second quarter. It also raised its full-year guidance. Medical devices in particular were helping Johnson & Johnson here. MedTech adjusted operating revenue up by nearly 10%.
Yep.
So that's one of the things that helped J&J.
Yeah, and then you also had Kenvue out as well. We know that's the spinoff from Johnson & Johnson. Of course, Johnson & Johnson still has like a 90% stake.
Yes,
they
86%.
Or 86 to me, yes, basically. I mean, you round up.
Yes.
Little math there. And, Kenvue is just continuing to just retain their position in consumer and the strength of, say, whether we're talking about Tylenol or Band-Aid. Tylenol doesn't do anything for me. That's not strong enough. So they had to beat the earnings per share, 32 cents a share for Kenvue. So that's another one in the healthcare space that we're watching as well.
Yeah. I mean, Kenvue is also interesting because they spun it off. As you said, they still own most of it, the vast majority of it.
Yes.
They had their IPO back in May at $22 a share, and the shares have actually performed well since then. They're down 7% today, but they had risen about 14% going into this report since they had that initial public offering. The company says for sales growth for the full year, going to be 4.5% to 5.5%. So J&J, interesting former parent company, still kind of the parent company, going higher, Kenvue going lower. I also just quickly wanted to mention Abbott Labs while we're talking about what's going on with medical companies reporting here. Here, too, it is seeing a boost in sales for its medical devices, earnings per share beating estimates. As you can see, revenue also beating estimates. The company not changing its full year guidance, but the shares are trading higher by about 2%. So it looks like that revenue, that medical device revenue rising 13.5%, helping things.
The medical device story we've heard as well within the kind of healthcare space as well, especially like when they have to account for the decline in things like testing, COVID-19 testing. We're not going to see that like we did a year or 2 years ago. So that's certainly been accretive to Abbott Laboratories. So yeah, to your point, they had a beat on earnings, 78 cents a share. Revenue beat, even if they decline in general.
Right, exactly. We are going to dig much more into Johnson & Johnson in particular. We'll speak to CFO Joe Wolk in the next hour. We're also going to speak to the CEO of that spinoff, Kenvue, that we were just talking about. Should be very interesting conversations.
And stay with us. All your market action is ahead. You're watching Yahoo Finance.
Why aren't we in a recession yet?
So that's a complicated question, but I think there's a big bed of liquidity that the tightening of financial conditions is still kind of chewing its way through. That bed of liquidity was created in the pandemic through fiscal transfers, excess savings, and so the lag effect of monetary policy tightening is taking longer than a typical cycle has.
I always tell people that they should be maxing out their 401ks. And if you can't max it out, start somewhere. It doesn't matter if you start small and then you up it every single year, even 1%.
There's no question that the current economic environment we're in, with inflation running as hot as it's been for the last 2 years, has caused people to be in more of a pinch than maybe they were before.
There's two ways to really build significant wealth. One is through real estate, great investment. You get some tax advantages. Stocks are the other way. For most people, that's going to be the most viable way.
First, you've got to have savings. Second thing you want to do is really maximize your employer plan. You want to make sure you're getting the full match before you do anything else.
As a busy week of earnings begins to wind down, at least for this week, how have the markets reacted? With more, Jared Blickery joins us from the New York Stock Exchange. So Jared, take it away.
Well, we're looking at some bullishness in the Dow right now, but not necessarily the other markets. I'm seeing this on the Wi-Fi Interactive. Dow up about 0.5%, but check out the week's gains. 4 days into this week, the Dow is up 2%, and that is outperforming the tech-heavy Nasdaq, up about 1 1/3%. Let me take a little bit of a bigger picture view here. Here's the S&P 500 over the last 3 years, or Dow, excuse me, and you can see it is just now climbing above the neckline of this very protracted bottom that we've had. That includes this bear market that we climbed out of, and it's full speed ahead here for the Dow as well as the transport. So we've been talking about Dow theory this week, how they're confirming each other, and also how it's not just Dow theory, it's kind of the everything theory, because we've seen semiconductors at record high. We've seen, not this one in particular, but the SMH ETF. We've been seeing home builders, which you just mentioned, those are at record highs. And it's just incredible to watch the drop in volatility and how that has facilitated the bullishness in this market. Here is the VIX over the last 3 years, and you can really see how we've crashed through a number of floors. And most recently, the big crash that was on my radar was that in June. Let me just show you the MOVE index, because this is markedly different. We are still elevated in terms of the move. We are off of the highs, but still elevated, meaning bond volatility has not gone away. But when it takes a look, when we take in consideration only what's going on with stocks, and I'm writing about this in the morning brief, this is a very bullish setup. When the VIX drops to under 14, I have colored in pink here the runs that we see in the stock market. And you can see here, there's a protracted one going up, going back to 92 to 97. By the way, this chart goes all the way back to the beginning of VIX calculations in 1990. We see another big one in the lead up to the global financial crisis. We see some other ones here. I see probably 4 distinct rallies. And guess what? We are in the midst of another one, the beginning of another one. No guarantees on how long this lasts, but it is a very, very strong tailwind. And then, by the way, just because we're talking about options, I'm going to mention that tomorrow, options expiration for the month, so we could see some fireworks in individual issues going into that. But from what I'm reading, it's not a very big options expiration in terms of the gamma that's rolling off. And I don't want to sink into the weeds on this one, but full speed ahead. I guess that's where I'm circling back to, guys.
That's definitely not in the weeds. That message is loud and clear, Jared. Thank you so much. Well, this earnings season is the latest test for the market's impressive year-to-date rally amid headwinds from near-future recessionary fears. So in the face of a possible downturn at some point, what's an investor to do? Our next guest finds the smart play lies outside equities. With more, we're joined by Sonali Peer, PIMCO Managing Director and Portfolio Manager. Sonali, thank you so much for being here. So investors who are facing down this earnings season, and there is a lot of sort of noise around it, right, about concerns over falling profits overall. Where should they be looking in the corporate bond stack to take advantage of maybe riding their way out through the earnings season?
Having me. Yes, we think that investors can find value in high quality fixed income, be that securitized, investment grade, and even some parts of the high yield market. So specifically looking at agency mortgages, valuations have become much more attractive, especially as the Fed allows balance sheet roll off there. Within investment grade, these are high quality companies where, bankruptcy is quite remote and offering a good starting yield.
So speaking of, you say a starting yield, can it beat the return on equities right now?
And that's what's really interesting. And I think a key takeaway is that, versus the long-term equity returns, fixed income is looking very attractive, right, with much less volatility. And should we hit a recession, equities would likely bear the brunt of that. So versus a long-term equity valuation, fixed income is looking rather attractive. And as we, given our preference in high-quality fixed income, that should outperform in a recessionary environment.
Are there particular areas that you're looking there within particular sectors, for example, within high quality fixed income that are attractive right now?
Yeah, certainly. So, agency mortgages have really widened and become more attractive in part because of the lesser footprint of the Fed. We do tend to prefer the higher coupons there. Within investment grade, industries, we tend to prefer, some of the non-cyclicals such as utilities, as well as, I think in financials, especially given what we've seen this year with the regional banks and the like, it's much more nuanced in terms of what part of the capital structure and which financials. And then, as we go lower in quality, preferring areas where we think the cash flows are much more predictable and avoiding some of the sectors that, have low margins, low multiples, and will struggle through an inflationary environment, as well as an environment where we may see lower stock market levels.
So when you say lower end quality, what does that mean outside of like agency mortgage? Like, where are we talking about?
Certainly. So, the health of the high yield market has actually improved over the last decade as some of these risks have shifted to the bank loan market or the private credit market. So, that's not to say that, all of, this is definitely an area today with high dispersion. And so, we're certainly taking a keen eye with our research analysts looking for, looking at industry selection, security selection quite specifically. But, what I would say is, should we hit a recessionary environment, there will be more opportunities in the bank loan and private credit space. But today, we see the fundamentals of high yield as being a bit more robust.
And you said, should we hit a recession? So should we hit a recession, there is the potential for some defaults, right? Some companies on their debt. So I guess I would ask, what does the default rate on debt look like should we hit a recession?
Yeah, certainly it'll pick up from the low levels of, that we've had more recently. But, we're still forecasting high yield to have a default rate of, call it 3 to 5%. And the reason it's relatively low and it includes the long-term high yield default rate is really because, companies have termed out their debt after the Fed had stepped in during the peak COVID experience. That the subsequent 18 months, the back half of 2020 and throughout 2021, there was significant issuance. And given the low level of rates at that time, they really termed out their debt. That only 18% of high yield is coming due over the next 3 years, which certainly helps subdue the default rate.
Sonali, there's an interesting story on Bloomberg today that says that this may be as good as it gets when it comes to corporate bonds, that there has been this rally in the first half of the year, but that the spread over government debt is pretty low, and there are concerns about how much it can be sustained. Is that why, first of all, do you agree? And do you think then that means that corporate bond investors are going to need to be more selective going into the second half?
From our perspective, it's always about active selection between industries, between securities within the capital structure, and we're always looking to take advantage of dislocations. That said, with respect to fixed income, spreads have rallied from a credit perspective. However, even if credit spreads were to widen on the margin, the starting level of income due to these level of yields helps bear some of that. And so, potentially positive returns, even with some spread widening.
And Sonali, I want to ask you about, let's say there's more volatility to come. Who's pricing it better? Is fixed income? I think you probably have a strong opinion on this. Or is the equity market pricing in volatility better?
Right. So I think with where equities are today and with the potential for a recession, just on a look ahead basis, there's much more downside protection in fixed income than there is in equities, right? So, from that perspective, given the current coupon and current yield that you'll generate in fixed income as you wait for the recession or as it comes, there's definitely more downside protection in fixed income and still the ability to participate in some of the upside.
All right, Sonali, thank you so much. Sonali Peer, PIMCO Managing Director and Portfolio Manager. Appreciate it.
Thank you.
We got much more markets action ahead. You're watching Yahoo Finance. Are stocks going to be higher or lower at the end of earnings season?
We think probably lower. You're still going to have earnings disappointment. The quarter's projected to be down, so prices have disappointed when earnings don't meet expectations.
We've got some great interviews coming up on tap in the next hour. How AI could change the future of the labor force. We're going to speak with Apollo Global Management's Torsten Slok.
That's next. Plus, we'll be speaking with Johnson & Johnson CFO Joe Wolk on the back of those results. You don't want to miss that. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Are you planning to watch the Women's World Cup, which is
I am. I'm excited for it. I think it's got more energy around it and more viewership than we've seen in a long time, probably ever, frankly. So I think it'll be exciting. I think the U.S. is going to do well, surprisingly.
It is just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Diane King Hall alongside the fabulous Julie Hyman. We're about 30 minutes into the trading day. Let's take a look at how stocks are moving. The Nasdaq ticking slightly lower this morning as investors weigh the latest round of quarterly earnings from heavy hitters like Netflix and Tesla.
And speaking of Tesla, shares are dipping this morning. This after Elon Musk's announcement on the earnings call that vehicle production would slow during the third quarter due to shutdowns for factory improvements. Musk also mentioning that future price cuts could be on the table, even though previous trims continued to weigh on Tesla's margins in the second quarter.
Over to the home builders. Shares of D.R. Horton lower this morning after the company saw quarterly net sale orders jump 37%. Now, D.R. Horton saying the low supply of affordable new and existing homes continues to drive home demand, even against the headwinds of elevated mortgage rates and inflationary pressure. So looking like a little bit of profit taking right now.
Yeah, it looks like it. Shares of Discovery Financial sliding a lot, down 15%, though the numbers did beat expectations last quarter. The company raising alarm bells with news of an investigation into, quote, incorrectly classified credit card accounts. Discover calculated a liability of $365 million related to that, though it did say the mistake was not material to its financial statements. And speaking of the home market, we did just get existing home sales out just moments ago, falling 3.3% in June to an annual pace of 4.16 million. That is a little bit weaker than estimated.
A little bit weaker than estimated, but some analysts would say it's not so much a demand issue, it's more of a supply issue, especially as we consider how tight inventory levels have been with regard to the housing market.
Yeah, I'm seeing one figure in here, the number of homes for sale, 1.08 million. That is the lowest for June ever. So there just aren't as many homes out there. Contract closings down 3.3%, as I said. And if you look at year over year, you see a 17% drop on an unadjusted basis. And basically, we've talked about this before, people don't want to put their homes on the market because the next house they buy, they're going to have to pay
more
rates.
Exactly. And the price is holding up of homes in general. That's the median price was a little over $410,000. Not the highest price ever, but the second highest.
So that implies, normally when you have mortgage rates go up, prices moderate a little bit, but that just does not seem to be happening to the same degree that we have seen in the past.
We'll see if it does happen. All right. The resilience of the U.S. consumer has been one of the stories of the year and has kept a so-called imminent recession just out of arm's reach. But the backdrop has become more nuanced in recent weeks. Surveys showing tightening credit and weakening consumer demand contrast with upbeat consumer confidence readings. So optimism is trending upward, but spending isn't. Let's get to Apollo Global Management Chief Economist Torsten Slok, who has some great insight on this. So Torsten, first, thank you so much for joining us this morning. I want to ask you, though, what do you make of that? Is there a disconnect between how the consumer is feeling versus what's actually happening?
Oh, that's a very good question, Diana. I think that the key way that we should be thinking about this is that the Federal Reserve started raising interest rates last year. And when they started raising interest rates, the economy gradually started slowing down. It was the interest rate sensitive components of the economy that slowed down first. It was housing that slowed down. It was purchases of autos, purchases of washers, dryers, furniture, anything that requires financing. Saw an initial reaction in a gradual deceleration. Now that's also spreading to other parts, in particular of consumer services. Going to a restaurant doesn't normally require financing the same way that if I go out and buy a new piece of furniture. So what's noteworthy is that we've begun to see some slowdown in restaurant indicators. So the broad answer to your question is that this process for the Fed of slowing the economy down is just taking a bit longer time than what we all had expected just even 6 months ago. But it is in motion, as you're mentioning. Delinquency rates have gone up on credit cards, on auto loans. We're seeing slowing growth in retail sales, in same-store sales. So the conclusion is we're still in this process of slowing growth down for the consumer. It's just taking a little bit longer time, most likely because they still have savings left. But at the end of this, in the next few quarters, consumption should continue to be lower.
Well, one of the other things, Torsten, hey, it's Julie here. One of the other things that's cushioning them is they have jobs. And guess what? Not only jobs, but they're actually making more money. And finally, we are seeing wage growth outpace inflation. So given that, it's taking longer. How much longer is it going to take?
No, you're right. And as you reported on earlier this morning, also jobless claims today actually came in a bit lower than last week. Continuing claims, meaning how many people filed for claims, meaning for unemployment benefits, actually went up a little bit. But the conclusion still is exactly what you're saying, that it is a little bit of a puzzle and probably some frustration at the Fed. Why is it that the labor market is still holding up so well? Let's not forget that the whole reason why the Fed is raising interest rates is that they want to slow the economy down. They want people to buy fewer cars. They want people to spend less money on their credit cards. They want companies to hire fewer people. But it's just not quite happening yet. So that's why this waiting game that we've been in, where for a long time financial markets have been saying, oh, the wolf is coming, a recession is just around the corner. We probably have to wait a little while longer. And I do still think that the main reason for that is that the amount of savings that people have left after the pandemic are still substantial, and therefore we need to run through those savings, and that's what we will see over the next 6 months, where those savings begin to run out for different types of households, and ultimately, therefore, that will begin to create an increase in the unemployment rate.
So what is it that does start to impact? Because I'm glad you brought that up. I was thinking of the excess saving. Consumer bank accounts have been propped up. We continue to talk about that leftover savings from the stimulus. And again, the strength in the job market, excess savings, I guess, based on some 2022 data, was at just under $1 trillion. How long does that excess savings runway last? Is it dented by, say, the coming back of these student loan payments?
Yeah, no, this is a really good question, Diana, because the issue is that even the Fed, there are several working papers that have tried to quantify the answer to your question. So San Francisco Fed came to the conclusion that there's still plenty of savings. The Federal Reserve in Washington basically came to the conclusion that, well, households have already run out of savings. So the jury is still out on that question. That's why the homework for us in markets is to try to look at some of the weekly and even daily indicators, and of course also the monthly indicators for what are consumers actually doing. And what we saw in retail sales that came out here last week, we basically saw again step down more and more in consumption. There's a lot of different areas where consumption is still doing okay. There's some areas where it's slowing a bit more, but the big picture really is that consumer spending, if you look at it year over year, continues to move lower and lower. And in particular with inflation coming down, remember, retail sales is measured in nominal terms, and inflation in nominal terms is of course coming lower and lower. And if that's the case, you should also expect consumer spending in nominal terms to come down. But the conclusion is, to your question, we have been waiting for this recession for a while, but it will come. We just have to wait a little while longer. And that's what's so most important for markets today, because equities obviously are not trading as if a recession is coming.
No, they are definitely not. Torsten, as we talk about the dynamics in the job market, I want to switch gears and talk about something that you've also really dug into a lot, and that's AI and its effect on the workplace here. Some of the work that you've done, some of the study work that you have done has shown sort of a split in workers in terms of how concerned they are about AI. Let's see, I'm just looking at the figures here. 60% of workers are worried about losing their jobs to AI in the next 10 years. Almost 2/3 of workers are using AI in finance and manufacturing say that it has improved enjoyment of their job. So how are you thinking about it when it comes to the long-term labor market trends?
Yeah, this is a really important question, Julie, because I do think that we need to take this very seriously. This is a very important productivity booster for the US economy and for the global economy. The difficulty today is that there are certainly at this point a lot of uncertainties about what will it imply. But what that OECD survey, exactly as you're highlighting, did mention was that, well, let's try and ask consumers, let's try and ask workers how they think about it. And in particular in manufacturing and finance, which are obvious areas where AI can be used, there's certainly a lot of ways that this can be helpful for increasing productivities on a number of different fronts. It still is really difficult to quantify how significant this will be, but it's very clear that this is a major trend that is going to have a very significant impact on the broader economy, most importantly on how productive we all are, but also in terms of the broader picture for when you think about where everything is going in terms of investment, in terms of CapEx spending, and in terms of businesses and how they organize themselves.
And then how worried, a lot of people are worried about, say, AI replacing them and replacing their place in the workplace. And, you know, is it all going to be robots? I mean, you have Elon Musk in the, oh my gosh, I'm having a brain fart on what
Tesla bot.
Yes, the Tesla bot, but there's another name for it. There's like an inside name for it. How worried should people be about this?
Yeah, so I know this is a new shiny thing that we all are spending so much time on at the moment, and as we all agree, it's difficult at this point. But I still think that this is something we will not all be replaced in the financial system, in the manufacturing, or really in the broader economy. I think we should think of this as something that can be a helpful tool. But if you go today in ChatGPT, just write in who is, and then write your own name. Then I was really surprised at how many mistakes it did in terms of it just scrapes the internet and figures out what's out there. But even from that perspective, I have so far not been super impressed because it always requires human judgment in terms of what it gives you before you want to send this to clients, before you want to send this to customers, before you want to replace any of your telemarketing assistants. So I still think that let's see where we go with this. It is something that likely will be helpful as a tool. But to your question, Diana, I still think that this will not be replacing jobs to the degree that many people fear, because ultimately human judgment will be the critical part, in particular if this is put in front of customers to make sure that customers are serviced the right way.
Torsten, if you zoom out even further, I mean, if you look back at the history of technological innovation in economic cycles, you think about the Industrial Revolution, you think about the Internet Revolution, et cetera. How are you thinking about this and placing it? And what do we tend to see when we have these types of sort of large-scale technological innovations hitting the economy?
Yeah, no, this is a really also important question because what still remains uncertain today is this the internet? Or is this Y2K or central bank digital currencies, which none of the last two things have really taken off that much? So from that dimension and from the very high level, as you're asking, Julie, I think the question is that I still think it will be another tool for how we all do our jobs in financial markets, in journalism, everywhere, for basically trying to figure out a way maybe to do things better, but ultimately the judgment that is required to figure out, is this then the right way to do things? Should I be putting things together the way that ChatGPT or AI or these generative models, how they have produced things, requires some human judgment that I still think will be impossible to replace, because that requires not only a judgment about, maybe the facts are correct, but maybe the context of these things being presented or being done or put into the production is not the right one. So I still think that humans will absolutely still be needed. And therefore, the upbeat message in this discussion about AI is that I don't think, and in that sense, I agree with the OECD report that you highlighted, Julie, that I agree with this view that this is probably going to create more jobs rather than be something that creates fewer jobs.
So Torsten, I never thought to search myself on ChatGPT, and I just did that. I was like, oh, let me log in and search and see. It said as of my last update in September 2021.
Does it look true?
It's questionable. I mean, it says I'm a talented journalist. I like that. I appreciate that.
Check so far.
It doesn't give my age, so I'm actually happy with that.
So in that case, it works, I guess.
It's fine.
And Torsten, I should have asked this with the consumer spending question, but I do want to switch gears finally and ask you another question, because I know you are sort of an omnivore and you think about a lot of different things that affect the economy. I want to talk to you about climate change and heat more specifically. We spoke earlier in the show to Steve Sosnick, and he brought up the idea that even though we have not seen a huge surge in electricity rates, people are running their air conditioners more right now, right? If you look at the heat and how it has spread across the country and how acute it is, even in the middle of the night seeing high temperatures, one would think that even if the rates aren't going up, people are spending more on electricity right now. Is that going, do you think, to be a drain on spending as well if people are spending more on their utility bills and less on other stuff?
Absolutely. Traditionally, if people spend more on energy, on either if this is filling gas on their cars, if this is paying electricity or heating in their home, that always sucks money out of other types of spending. So yes, if energy prices do go up, then we should expect that to have a negative impact on consumption more broadly. The good news is, as we talked about earlier, is that consumption is still doing okay, both in retail sales, also the same store sales on the weekly basis is still at okay levels. But the trend in the last several months is still on the back of the Fed hiking rates, still that consumption is coming lower and lower. So if now with that backdrop and putting together everything that we have talked about in this great conversation, if we both have the Fed hiking rates and the economy slowing, and we now also get at the same time a spike high in energy prices, we do get a cocktail of more things weighing on growth. And adding to that, also consumers now having to pay more on student loans here starting in September, then we also will get another drag downwards on consumption, and therefore ultimately more risk that the slowdown in consumer spending will finally arrive after all this time when the Fed has been hiking rates.
Yes, we shall see. Torsten, so great to catch up with you. Torsten Slok, Apollo Global Management Chief Economist, thank you.
Thank you.
We got much more coming up. Stay tuned. You're watching Yahoo Finance. I understand you're a sports fan.
I am.
We've been asking people about pickleball since it's all the rage. Have you tried it yet?
I have not tried it, but I walk by pickleball courts here in New York City every day.
Yes.
And
it's a war zone. There are people who are very upset about those pickleball courts.
I think I have to try it. I'm excited to try it, but I've not done so.
It's pretty fun.
Is it?
Yeah.
It's good exercise too, right?
Yeah,
for us getting older, who can't maybe maneuver as quick as we can for the U.S. Open tennis tournament and everything else.
Let's do a check of the market, sponsored by Tasty Trade. All three major averages going in different directions, particularly the Nasdaq taking a hit today, down 1%, being dragged down by the likes of Tesla and Netflix. The Dow being propped up by the likes of IBM and Johnson & Johnson. In other words, it's earnings season, folks. So this is typical of what we can see, given the different weights and the different averages. And speaking of Tesla, earnings came out, of course, after bell yesterday. The automaker did beat on both top and bottom lines, but disappointed on margins, continuing to trade volume, or to trade price for volume, rather, battling with that ratio. It's a trade-off that many consumer product companies have been making as well. Most of them have chosen to raise prices at the expense of volume. Tesla, though, has been going in the other direction. As a result, automotive margins were 18% last quarter, the weakest since 2017. And shares are still trading to the downside in the aftermath. Elon Musk did imply that this will continue to happen. The company will continue to see cuts to prices here. Let's talk about whether they're going to make up that profitability in other areas of the business. We're joined by Canaccord Genuity Managing Director George Giannoulias to discuss more. George, so this is really the question here that we're trying to figure out, okay, if the margins go down, where is that margin going to growth going to come from, and how soon is it going to come?
Hi, good morning, and thanks for having me. So first, we'd like to say that the company is doing this consciously. They're prioritizing unit over near-term margin because over time, they expect to be able to sell their full self-driving software, $15,000 upgrade, to customers at a higher rate. So currently, we estimate that they likely have a high single-digit penetration rate globally, but over time, as the software gets better, and we've been promised over and over again that it will, that penetration rate will go significantly higher. And when you think about it, that really, really helps margins over the long term, right? Last quarter, they printed about a 17%, what we call a pure auto gross margin. And if you add $15,000 to that, that essentially doubles. So we think this is a very conscious effort on their part to seed the market with units such that over time, they can improve margins. They're also investing in other projects, whether it's building this autonomous/AI infrastructure, investing in the robots that you referred to with your earlier guest, or battery innovation with their 4680 cells. So what they're doing by seeding the market with units and investing in these growth projects is, despite the erratic environment, putting money to work to create long-term durable growth.
So George, what is, you mentioned the FSD, full self-driving. They talked a lot about that on the earnings call. What is, I guess, the upside value proposition of this, given where it is in the development?
I mean, look, essentially, the way we think about it is that, fast forward 2, 3, 4, 5 years from now, buying a car, a Tesla, without the full self-driving software will be like buying an iPhone without an internet connection. It'll be essential and add such value to your driving experience that you won't want to buy a car without it. So this will essentially allow a vehicle to drive itself. Level 4, eyes off, hopefully hands off over time. There's a competitor out there called Mobileye that we also cover that's enabling vehicles with the same software. Also a company called Aurora that's doing the same for autonomous trucking. So we think that autonomous vehicles, autonomous driving technology is real-world AI that'll make the world significantly better over time. Not only will it result in lower resource utilization, but also save lives. So we can't think of a better way to deploy AI in the world than through autonomous driving.
I don't want to get into too deeply into the FSD debate. I mean, I think there's the promise of the technology, and then there's the real world we live in and human psychology, which I think is going to be quite a stumbling block for this. But, as I said, I don't want to go too deeply on that rabbit hole. Instead, I want to take a little bit of a turn and ask you about something we were discussing earlier that was a bit of a mystery in the Tesla earnings. And that's this sort of 9 cents of other that led them to beat estimates on the bottom line. And I think we were trying to figure out what that other is, whether it was FX or something else. What was that?
The majority, 9 to 10 cents, was FX related. And when the Q comes out, we'll be able to figure out what this, they also had a huge or pretty material swing in other things related to joint ventures. So there was some bottom line stuff that happened that was one time in nature. That helped the earnings. But I think most people have looked a little bit deeper and looked past it and saw that the gross margins, while better than the worst Wall Street fears, missed our estimates by a little bit, as did the operating margins. But we feel comfortable that if you have an extended view, a 6, 12, 24 month, even longer than that view, what the company is doing is investing in future growth by having the margins both on the gross and operating side come down a little bit in the near term.
George, there was a question that came up on the earnings call about when gross margins would stabilize. They kind of batted that away and they didn't land on a date. And they said it didn't matter because Tesla is a, quote, epic long-term investment. So given that statement and then just kind of your read on the results, is Tesla a buy or hold or even a sell from your point of view?
Look, first of all, to answer the second question, it's a buy. And with regards to their commentary, look, they were elusive on calling a bottom. And I think I know why. Well, basically, a couple of quarters ago, the CFO came out and said, we're not going to break 20% pure gross margins. Well, they did now for 2 quarters in a row. And they want to leave themselves the optionality to continue to seed the market with units and cut price if the auto market gets worse from here. I mean, look, it's been, by their own admission, a very erratic auto market, a very erratic macroeconomy. And so they don't want to commit to a bottoming in gross margins. We think that there's a bottoming in gross margins here. Commodity tailwinds are starting to positively impact them. Additional 4680 battery cells, as they scale, will help gross and operating margins. So we think that we'll be maybe in the 17 plus range for a little bit. And then as the Cybertruck starts to hit in the second half of the year, as they continue to improve volumes in 2024, we think gross margins are set to improve.
And I guess that's the question here. So if you should buy, and I know you have a $293 price target, I think is that the correct target for you?
Yep, that's right.
So if you want to buy, when is that catalyst coming? When are we going to see that upside? I mean, obviously it's down today. What's going to be that next catalyst and trigger?
I think there are a couple of those. So first, if you look at what we have coming for the second half of the year, we have an incredibly controversial vehicle coming in the Cybertruck. I personally love it. I would say it's an acquired taste for sure. But yesterday, Elon Musk said that demand is so far off the hook that it can't. You can't even see it. So
he didn't give us numbers though, did he?
Mm-hmm. No, look, and I think I know why. Look, I think the pre-orders, which I think you have to put about $100 down, are probably, if we believe what we read, in the millions. But we don't have final pricing. We don't have all the final specs. So when all those things clear, we'll see what real demand is. I happen to think this vehicle is so incredible that real demand will stay strong for an extended period of time. And they've guided for 250 to 500,000 in unit sales a year at their shareholder day. And so I think that's I think it's a very doable number. And when those vehicles hit the streets starting in the second half of the year, I happen to think that they will wow people. And so that's a significant catalyst.
George, I beg to differ. I'm sorry, it does not.
It's okay. My wife agrees with you too, by the way.
Yeah, I'm with her.
Oh my God. The Hummer. It's the Hummer of the EV age.
Exactly. That's what.
I will make judgments about people I see driving that thing. Sorry.
I disagree with both of you. I love it. I've seen it in person.
You can get one. We're with your wife on this one. There. Look at that picture. Oh my gosh. I'm sorry. It's, I don't know, part futuristic, part prehistoric. I don't know what to call it. Canaccord Genuity Managing Director George Gianarikas, thank you so much. We appreciate you.
Thanks for having me on.
All right. All your markets action ahead. Stay with us. You're watching Yahoo Finance.
Will the S&P 500 be higher or lower at the end of earnings season?
Oof. I wish I knew the answer to that definitively. I guess I would say right now the momentum is obviously moving in the higher direction. Earnings expectations, negative 7% growth year over year. So the bar is still pretty low, easy to get over it. I guess if I have to choose one, I'd say higher.
Johnson & Johnson is getting a boost this morning after seeing sales rise 6.3% in the second quarter. The company also raised its full-year guidance. The healthcare giant saw success in its med tech sector in particular. That jumped 12.9% year over year in terms of sales. Johnson & Johnson Chief Financial Officer Joe Wolk joins us now alongside our Anjali Khemlani. Joe, it's great to see you. Strong quarter from you guys. I want to dig into medical devices a little bit since that seemed to be such a driver for the quarter. I know there's some normalization here. We're still talking about normalization post-pandemic, people getting procedures done that they were holding off on. How long does that trend last? How long is that sort of catch-up tail, if you will?
Yeah, thanks for having me on, Julie. I would say it's difficult to predict, right? I think folks have been talking about a backlog of surgical procedures ever since the pandemic started to wind down. I would say that what you've heard from insurers, as well as some of our competitors, is that the senior citizens seem to be more willing to and receptive to coming in and getting their clinical procedures done that maybe they put off even after the pandemic had substantially been done. I would say the other thing that's an important factor is just the amazing healthcare workers. There's more stability in the workforce, so procedures are able to be scheduled on a normal cadence. And I think both of those are factoring in well. That certainly did help our earnings and our outlook for medtech, our performance in medtech. But I also wouldn't minimize just the new products we have in that space too that are catalyst to the growth that you're seeing, which we reported this morning. We have a robotic surgery assisted device for knees known as VELYS. We have a catheter known as Q-Dot Micro that is enabling better efficiency for technicians to treat heart arrhythmia in our electrophysiology business. And then just a fantastic new contact lens known as Oasis Max, which enables people who need glasses to see far away and also readers to see close up, the opportunity to have one contact lens to address that all. So there's the market that certainly is a nice tailwind, but it's also the contribution of newer products that we have going on.
Joe, Anjali here. I know that there was so much that drove this boost in the earnings this year, but I did hear a little bit about data and AI, and I wonder what you guys are thinking about in context of that. I know it's really been kind of ubiquitous in the industry for quite some time, and a lot of other companies are sort of taking advantage of the buzz around it to kind of brag. So tell me about how Johnson & Johnson's thinking about that.
Yeah, so Anjali, we've been actually investing in data analytics capability, machine learning, automated intelligence for a number of years now. We're building up that to be a capability with certainly an expertise in the function, but also making it a language that's understood by all of our associates. Where we see the real benefit is hopefully identifying drug candidates, identifying patients that may work on more effectively, and hopefully bringing down the cost of development for either medical surgical procedures or drug development. So that's where we really see the benefit. Obviously, the world is getting smarter with all the information. There's now some medical devices that, let's say, a knee implant has the prospectus down the road of potentially having information, a chip in that knee replacement system to let the orthopedic know how that patient's responding or maybe what's going wrong so that adjustments can be made appropriately. So there's a lot going on. Our robotic platforms for surgeries themselves certainly has a lot of, I'd say, automated intelligence in it. So we're maybe not as pronounced. It's not our bread and butter, so to speak, but we're certainly using it as an enabler to really focus on life-saving, medical, differentiated innovation.
I mean, and Joe, for you as the numbers guy, saving money is as sexy as any sort of technological innovation.
Absolutely.
So how soon do you expect to sort of see that part of it bearing fruit? In other words, bringing the cost of drug discovery and development down?
Yeah, I think it's going to take a couple years until we really refine the processes around it. I could say, though, Julie, and it is sexy to save money, we've been using this in some of our administrative functions. So some of the accounting functions, some of the HR processes, some of the information system processes in the background. We've already banked, I would say, hundreds of millions of dollars over the last few years by automating a number of these processes. So it's evolving, and I would think that the gains that would happen in drug development down the road certainly might have even more amplification and more benefit to the P&L.
Joe, I want to switch gears here a little bit and talk about the Inflation Reduction Act and the impacts there. I know you're not the chief legal counsel, but you did, the company did bring the lawsuit against the health department as well as Medicare on the drug pricing negotiations. What are you expecting about the impact financially that has sort of spurred this lawsuit?
Yeah, so, the lawsuit is really about what we feel is, like the Chamber of Commerce, like industry peers, the assault on innovation, right? If you think about what the government is looking to do here, it's essentially set prices. There recently was a report that was issued that suggested 85% of Americans have access to new medicines in that first year when they become available. That number, quite frankly, in my opinion, should be 100%. You contrast that with governments that set prices, let's say France and Canada. Those numbers dropped to 43% and 21%. So this really serves to hurt patients. In terms of the impact to J&J, we'll have to see. We don't even have the list of drugs quite yet. And we're broadly based across both of our portfolios, medtech and pharmaceuticals. So we're well positioned to absorb any impact. It's less about that. But Anjali, I know you and I have spoken in quarters past where to reduce inflation, I think they've gone after the wrong target here. We just issued our 6th annual transparency report, and that report indicates that we've decreased prices in 2022 by 3.5% in our pharmaceutical portfolio. Contrast that to when you went to the grocery store, when you went to fill up your gas tank. It's very, very different. And while those are Johnson & Johnson numbers I referenced, it's really emblematic of the industry. Discounts and rebates as a percent of list price have gone from roughly on average 25% 5 to 6 years ago to now 55%. But unfortunately, those discounts and rebates aren't getting into the patient's hands that need them. Copays are going up, insurance premiums are going up. So I think they focused on the wrong target here.
It's interesting because I think it feels like, at least in the popular perception, Joe, that it's not so much drug prices overall. It is really some particular drugs that stand out as being unusually expensive, or what seems to the layperson as unusually expensive. How does the industry, as an industry, sort of tackle that issue?
Yeah, so it's something we're very cognizant of, Julie. When we have great innovation, it doesn't really do anybody good if they can't afford it or they don't have access. So one of the principles that we pride ourselves on here at Johnson & Johnson, and I believe it's the pharmaceutical industry in general, is we want to make sure that folks have access to these medicines. In addition to the discounts and rebates I mentioned, there's monies that are being funneled to copay foundations to help people access these medicines. So again, I think there's the perception, the popular perception, as you put it, that when folks walk into a pharmacy on a monthly basis where they used to pay $10, maybe $5 for their copay, now they're paying $75 to $100. They associate that with the drug manufacturer, the innovator who's taking the risk and putting capital to work for these differentiated healthcare solutions. It's really it's a convoluted and confusing system for most patients.
And Joe, to go back to the company's outlook. I saw a little bit of analyst commentary today that actually called your forecast conservative if things sort of go right. What's the potential upside here for this year?
Yeah, so there's more to meet the eye in our earnings guidance going forward. We did take our earnings up by 10 cents per share. But the operational improvement that belies that is really 28 cents per share. There are two discrete factors that were strategic in nature that really kept it at a dime. The first is our non-controlling interest in Kenvue, the consumer health company that we're separating out. That's simply a matter of accounting, and that's worth about 8 cents. The other is an investment we made during the quarter worth about 10 cents per share to really expand our portfolio, improve our future outlook for cell-based therapies, specifically for B-cell malignancies. A lot of our competitors actually take guidance down when they have those type of investments. Here, our performance was so strong that we were able to digest both of those items, and they're great strategic plays for the future.
And speaking of Kenvue, by the way, we're going to be speaking to the CEO of that company in just a few moments. So a great twofer that we got here today, Joe.
Great.
Good to talk to you. Joe Wolk, Johnson & Johnson CFO, and our Anjali Khemlani. Thank you. Well, coming up next, we're going to hear from the Kenvue CEO and much more. You're watching Yahoo Finance. What is your favorite chart or indicator right now?
Favorite chart or indicator? I mean, it doesn't signal good things, but I continue to be kept up at night by the yield curve inversions. They've stayed really deep. They've been here for a long time. They don't usually signal clear skies ahead, so watching that for what happens when they start to re-steepen, that usually does inflict pain on the equity market.
Welcome back to Yahoo Finance Live. I am senior health reporter Anjali Kimlani. Kenvue shares dropping despite the consumer health company beating second quarter earnings estimates and issuing an upbeat sales outlook. The beat was fueled by demand for brands such as Band-Aid, Tylenol, and Listerine. Kenvue is a spinoff from J&J. They spun off this year. This is their very first earnings report since IPO a few months ago. So while J&J still owns about 86% of the company, it intends to split off through an exchange offer by the end of this year. And joining us now to talk about all of it and more is Thibaut Mongeau, Kenvue CEO. Thibaut, really great to have you join us this year and good to see you again. I want to talk about this really strong earnings that you just reported, stronger than it has been quarter over quarter for quite a number of the last few years. So let's talk about that. What's driving this? And do you expect this to kind of stay put considering the sort of inflationary environment we find ourselves in today?
Yeah, good morning, Anjali, and thank you for having me. Good to see you again. We had indeed a very strong quarter at Kenvue, a strong debut for us as a publicly traded company. And probably is one of the strongest quarter in our 135-year history, $4 billion in revenue, 7.7% growth organically, a balanced growth across all segments of our portfolio, across all geographies. As you mentioned, strong demand for brands like Tylenol, Motrin, Neutrogena, and so many others. So all credit goes to the team, but good to see the strong demand for Kenvue products. I think it talks to the fact that the consumer health space is very resilient, but also to the fact that the consumer, the Kenvue portfolio is very strong. So happy about our results, confident in our future as well. You have seen that we have announced this morning our dividend, 20 cents for the third quarter. We initiate our dividend payment program, so very confident in the future and a big day for Kenvue.
Absolutely. Let's talk about that moving forward. I know that J&J is still going to be including the results for Kenvue in their consumer segment. So you're sort of two sides, if you will. I know we had joked during the IPO about you getting the keys to the car. You're 16 years old driving off. But it seems like parents are still in the back seat. So talk to me about what that means in terms of how you are operating as CEO and what you expect in terms of the rest of the year.
Yeah, so we have been operating as a standalone company since our IPO in May. Very pleased with the way our IPO has been received by investors around the world. Johnson & Johnson just announced this morning their intention to separate from Kenvue this year, and that's according to the plan. That has always been the plan for Johnson & Johnson to separate from Kenvue in 2023, and that's what Johnson & Johnson confirmed this morning. So I can tell you that the IPO released a lot of energy in the organization. We are fully ready to operate as an independent company and very excited about our future.
I was on the earnings call, and I know that there's a lot of concern about the environment you find yourself in. Lots of strong results, like I said, for a number of products, especially this quarter. But when you're looking at towards the end of the year, there is some uncertainty. I know the Russian market is on the table, as well as just generally, like I mentioned, this inflationary environment. What are you looking at in terms of how you're thinking about the outlook for the rest of the year, and what specific segments you think might have the most volatility?
Yeah, we certainly live in a volatile environment and with continued uncertainty, and it's certainly something that we're going to see between now and the end of the year. Having said that, what we see in our portfolio is that consumers, more than ever, are focused on their health and well-being. They are looking for products that are efficacious, that they can trust, that are recommended by their healthcare professionals, that has been in their medicine cabinet for many years, many decades, sometimes a few generations. And that's what we offer at Kenvue with our portfolio of iconic brands. So we see consumers continuing to really look for efficacious solutions and our brands. That's what we saw in the second quarter results. To give you an example, we are in the middle of the summer season. We are the market leader with Neutrogena. We launched new innovation, premium innovation this summer that has been extremely well received. We are gaining share, and we see strong demand for our Neutrogena products in the summer in the US. So I think it tells you a lot about how consumers look at their health and well-being and the role our brands play in their daily routine.
And I know you're looking at guidance out for normal sort of winter. I know that's been an area of potential boosting in the last few years because of the pandemic and the tails from there. But when you're looking at what the stock is doing right now, what does that tell you about sort of what investors are thinking about what you've said about all of this?
Yeah, I think as we all know, many factors impact the stock price. I think this morning, J&J's announcement may play a role in the movement of the stock. It's not unexpected to see short-term movement between the J&J stock and the Kenvue stock in this particular moment. What we are focused on at Kenvue is the underlying performance of the business, and that's what we show in the second quarter results again. The strength of our Kenvue business model and the power of our portfolio, and that positions Kenvue as the largest pure-play consumer health company in the world, with unique sources of competitive advantage and solid financial performance. So that's what we are focused on.
Absolutely. Certainly brands that everybody knows. Well, Thibaut Mongon, CEO for Kenvue, thank you so much again for joining us after this quarter, and hope to talk to you again soon.
Thank you, Anjali.
All right. Our thanks to Anjali Kamblani for that great interview with the CEO of Kenvue. Meanwhile, as the 2024 presidential campaign gets underway, President Biden is touting claims of reducing the national debt as one key difference he's made in his first 2 years in office. But Yahoo Finance's Rick Newman says, not so fast. He joins us now. All right. Hi, Rick. What do you mean when you say not so fast?
I'm paying attention to all of Biden's speeches and appearances when he brags about Bidenomics and how well the economy is doing under his watch. And there's just one claim he keeps repeating that just grates on me. He says, I reduced the annual deficit by $1.7 trillion in 2 years. No president has ever done that. So you look into it and here are the facts. Technically, he's right, but the reason that he reduced the deficit is because of all the COVID aid, the fiscal stimulus in 2020 that pushed the deficit all the way up to $3.1 trillion, the most ever. So as that money ran out, the deficit naturally fell. So that's where Biden gets the $1.7 trillion in so-called savings. But the deficit is not doing well at all. It's much higher than it was before COVID, and it's going to be going up, not down, during the next few years. So if Biden leaves the impression with you that he has this debt addiction under control, he is not. Don't believe that.
Be that all of that as it may, Rick, it almost feels like just like him, the actual legitimate gains that he has made for the U.S. and the economy, just like voters are kind of ignoring that, it doesn't seem like that the deficit issues really tends to set people on fire unless you're talking about the GOP talking about deficits when it serves their purposes. But in general, like, do people get worked up over this stuff? Besides
so polls show that, yeah, I mean, but voters are concerned about the size of the national debt, which I believe is now around $32 trillion. I mean, it's so big, nobody even knows what $32 trillion is. But it generally becomes a sideshow during elections. People care much more about the economy today. And the debt, as big as it is, it has not yet caused the debt crisis or the fiscal crisis that many economists have been saying is coming. But, you know, for my purposes, Biden does have a lot he can brag about with regard to the economy without fudging the facts. I mean, labor growth under Biden has been fantastic, whether he deserves credit for that or not. We've had a massive growth in the labor force. I mean, the unemployment rate is extremely low. We're seeing inflation come down. So there are a lot of things Biden can point to without having to exaggerate or fudge. So this one just stands out when he talks about reducing the annual deficit, which he did not do at all.
Well, we appreciate you holding him to account, as always, Rick. Thank you so much. Appreciate it.
Bye, guys.
Bye.
Bye.
Let's take a final look at your markets here. Markets remain mixed, and in fact, more mixed than before because the Nasdaq is now more deeply in the red, off by 1.3%. The S&P falling about 0.4%. As we've talked about, the likes of Tesla and Netflix holding back the Nasdaq. The Dow higher by 0.75%.
And coming up, Rochelle Akufo picks up from here. She'll be taking another look at a Tesla earnings report, especially the $1 billion being pumped into the Dojo supercomputer. You don't want to miss that.
Yes, I don't.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Investors aren't loving results from heavy hitters like Tesla and Netflix. We'll give you a pulse check on results season so far. Plus, as the AI battle heats up, Apple is racing to catch up. We'll discuss what the tech giant's strategy could look like. And why a possible strike at UPS could steer the economy in a disastrous direction. We'll speak with Newsweek's Tom Rogers this hour. But first, let's get a check on the major indices at the moment. Looking at a mixed picture here, just now only seeing the Dow in positive territory there, up by about 260 points or 0.7%. Looking at the S&P 500 there, under a bit of pressure here, down about 1/3% here as we look at some of the sectors that are doing well. We're taking a look at the ones under pressure are communications as well as some tech stocks. Also taking a look at the Treasury yields here. The 5-year up about 3% on the day, the 10-year up about 2.5%, and the longest term 30-year yields, that's up about 1.5% on the day as well. Well, there's a lot going on this morning, so let's get you up to speed on all the action. Now, of course, the first of the supercharged big tech firms to report this earnings season, Tesla and Netflix, underwhelming the markets and knocking down a bullish Wall Street from 2023 highs. So here's a look at what happened. Now, Netflix's bottom line beat Wall Street estimates, and the company added almost 6 million new subscribers. And that's thanks in large part to those password crackdowns. Despite all that, though, shares are falling sharply this morning. That's after quarterly revenue disappointed. But Wall Street is still concerned about streaming profits that are plaguing the entire industry. And of course, concerns about the Hollywood strike also weighing on the company. During the earnings call, co-chief executive Ted Sarandos addressed the elephant in the room, saying he wanted to be, quote, absolutely clear that the dual strikes were not the outcome that the streamer wanted. Well, over in the chipmaker space, Taiwan Semiconductor shares sliding after the company posted its first profit drop in 4 years, with demand for consumer electronics continuing to slump. Now, the largest chipmaker in the world said high demand for artificial intelligence chips is not enough to offset broader end market weakness as the global economy recovers more slowly than it had expected. And speaking of global economy problems, Tesla CEO Elon Musk did not hesitate to blame exactly that for the company's worries. The CEO hinting at further price cuts and higher spending in the months ahead on Tesla's earnings call. Margins below expectations were the big concern, though, with operating income of $2.4 billion missing the street by a distance. Now, Musk says Tesla will have to keep dropping prices if rates continue to rise. Now this, as he confirmed Q3 production will slow amid factory upgrades. Investors, though, hoping for a detailed roadmap on the Cybertruck didn't get one. They'll also have been struck by Musk's comment on the Dojo supercomputer. It will cost over $1 billion by the end of 2024. But Tesla's biggest bulls are not worried about the company's promises or its massive valuation. Let's bring in one of those bulls now. Longtime Tesla investor and YouTuber Kevin Paffrath joins us now. So, Kevin, as we take a look at the reaction that we've seen from the street here, I mean, a lot of good to be found in the earnings report itself, but really honing in on some of those warning signs on price cuts, cutting into margins, and some of those incentives as well. Do you think the street has it right in their reaction to this right now?
No, Wall Street never has it right when it comes to Tesla. They, however, are right in the short term, right? Wall Street doesn't care about the robo-taxi. They don't care about AI. They don't care about Dojo. They don't care about full self-driving. The street is right to care about what they care about now, and that's near-term profitability. They care about near-term margin, near-term profit. And what did we hear? Well, we didn't hear, as you mentioned yourself, a date on the Cybertruck. We actually heard they're still testing the Cybertruck, which sort of made me scratch my head too. We didn't hear talk about them actually acknowledge that they are indeed advertising, which is something they agreed to do to sort of help boost the near-term profitability and reduce the need for price cuts. Instead, we potentially had hints of more price cuts coming. So all of the near-term ammunition that really said, hey, near-term profitability might be hurt more is what Wall Street got to say, all right, sell. Long-term, we didn't even get that great of a vision, though, on Cybertruck, which we were really hoping for more color on. And then something that I was a little disappointed on, don't get me wrong, still happy on, for Tesla long run here, but something that I thought was really odd was Elon's been talking up Dojo, the supercomputer for artificial intelligence. This is going to be the best supercomputer ever. But then he said, hey, but if we can get our hands on enough NVIDIA chips, we wouldn't even need Dojo. This was, in my opinion, kind of like saying, Your girlfriend is the best ever. But if I had my ex back, I wouldn't be with my girlfriend.
I love that analogy there because, I mean, investors really were looking for some clarity and some details here. And it did seem as if Musk was sort of hedging his bets on the calls. I mean, when we talk about FSD, I mean, this is something that started talking about in 2016, still really waiting to see it come to fruition here. And he even on the call called himself, the boy who cried FSD. But he's actually expecting to see that here and talking about seeing that potentially by the end of the year. What should you make then about Musk's promises when it comes to FSD and where we really are in the story and how much that means to Tesla?
Yeah, that's a great argument. It is true. He is a little bit the boy who cried FSD. Look, it is getting better. I use FSD on 2 different Teslas. It is getting phenomenally better at those edge case scenarios where sometimes it feels like it wants to drive you into the wall, and now it doesn't do that as much anymore, which kind of goes from like bad to great. Now it's acceptable. It's getting much better. I'm taking regular drives myself as a user where I'm finding myself more and more taking those drives going, wow, I didn't have to take over once on that drive, which is fantastic. Do I really think we're at that phase, though, where by the end of the year it's going to be at a perfect level? No, we're not going to be at 100%, I think, for a few years. However, Elon Musk did tease something that I thought has real potential, and that's licensing the software to other manufacturers like a Ford or GM. I personally think many of the ADAS softwares, like your adaptive cruise control or your lane keep assist, aren't that great at the Mercedes or Ford or GM. And if they can even just get autopilot from Tesla, Tesla could probably make maybe an extra $1,000, $2,000 of every car the other manufacturers sell. Now that would be a margin, that would be explosive for Tesla margins. I would expect that if as many of the companies that are adopting the NACS, the North American Charging Standard, start adapting even just autopilot, the lane keep and the ADAS on highways and streets, rather than even full self-driving, you could solely from those incremental revenues from other companies, which cost Tesla virtually nothing other than software, so probably 90+% margins, you could probably see the valuation of Tesla double on that alone. Unfortunately, we don't even have a taste of that yet. And so in the short term, it's very difficult for Wall Street to assign any value to that at all because they don't have a taste of, well, how much would that even sell for on a single car at a single manufacturer? But once it happens, it'll happen very quickly. So I remain very long-term optimistic for Tesla. But look, the bears are 100% right here in the short term. The earnings call was a disaster. Elon was probably tweeting during it anyway, and Elon's not really the best spokesperson for talking to Wall Street. Should have had a little bit more focus there on finance, on what they're doing to improve advertising and margin, and really, it's a Wall Street earnings call. Talk short-term in the earnings call, talk long-term at the Tesla events like the AI Day. That would have been better here.
And the thing is, I mean, and you talked about this here, this idea of really sort of having that data that you're now picking up by licensing what they have with the superchargers. Potentially talked about that OEM for doing the same thing with FSD as well. What is the long game here? Is it Tesla essentially making most of their money and gathering sort of this data from other companies, or relying on this Cybertruck to be the sort of the next level of growth, which he says, it's full of technology, didn't really give us any sort of specs on it at all, or even delivery dates. What's going to be that next growth driver for Tesla?
Yeah, I think that's really interesting what you're hitting on, because we were always first promised as Tesla investors that Tesla was the best at manufacturing cars and that you want to invest here because the profitability is so large for the vehicles. But now Elon Musk is somewhat U-turning to, oh, well, we could sell the cars for a break even. We'll make money off the software. But take rates for FSD are somewhere under 10%. So we're not even convinced today that FSD and software is really going to be a driver of revenue. So to hear Elon suggest that, well, okay, we used to be a company that focused so much on profitability in manufacturing to, well, that doesn't matter so much anymore. We want to profit off software, is definitely going to give Wall Street some pause, at least in the near term, until we can prove that software profitability. I believe in the long term, yes, we'll have a combination of profit. Even if we just maintain 15 to 25% margins on the cars, we'll still be well above industry average. And if we can layer onto that high quality software, which I think Tesla has. It's not 100% yet, but it's still very good, miles ahead of what anybody else has. Yes, you'll have a combined, very profitable company here. And that's why I'm an investor, not only myself, but also in my fund, my ETF. But beyond that, I have to say, you're right. You're kind of, as an investor in the short term, looking around and going, oh, okay, I thought that was the goal. Okay, now this is the goal. And Wall Street doesn't like those pivots.
And I mean, in terms of the amount of breathing room that Tesla has at the moment, as you do have, more of these legacy brands coming in with perhaps cheaper EV options as well, how strong, how dominant do you think Tesla's position is going to remain, at least in the short term?
Yeah, I mean, certainly I expect the pie to continue to grow of electric vehicles, but I think the more time goes by, the more folks end up giving Tesla a try. And I actually think some of the biggest investors of Tesla stock are retail. And now what's really interesting about this is when we look at funds specifically, we can see that only about 30% of funds out of the big 7 stocks have an allocation to Tesla at all, whereas about 71% of funds have an allocation to Apple, or somewhere around 60 to 80% of funds have an allocation to Meta, Nvidia, Google, Microsoft. So Tesla's still a little bit of the black sheep, where you've got a lot of very excited retail who love the vehicle, so they invest in the stock. And actually, the more Tesla continues to sell Teslas, the more retail investors I expect you're going to get, which eventually Wall Street will be convinced by. And that's probably where we end up getting real euphoria for the stock, where we could end up seeing more of a Cathie Woodian price direction, where we're starting to look at the $500-600, maybe even the $1,000+ range for the stock. But it's really going to take all of that happening, more retail, leading to finally seeing those software revenues, to finally seeing Wall Street turn and allocate appropriately to Tesla. But in the near term, you've got some headwinds before you're there. I think I may have missed all of your questions, so maybe restate anything if I missed there. Sorry about that.
No, you hit all the bases there. It's a lot for investors to take in. An interesting time, especially in the short term here. Always great to have you on. Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Thank you so much.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
What about surprises during the earnings season? Any early surprises thus far? And are there any other surprises you're looking for? Although I guess if you're looking for them, they're not as much surprises.
That's true. I would say the early read on the financials has been healthier than most people expected. There's certainly been deposit runoff. Credit has been a challenge, and investment banking has been a challenge for some of the larger firms, but overall they've beat expectations more than most people expected.
Let's do a check of the market sponsored by Tasty Trade. Still looking at a mixed picture here. The Dow here still bouncing around the session high so far this morning, up 250 points or 0.7%. The S&P 500 still slightly under some pressure though, down about 1/3%. Health though leading the way thanks to Johnson & Johnson, biggest laggard on the day. Consumer discretionary at the moment. Taking a look at the tech-heavy Nasdaq, those FANG stocks taking a hit, and Tesla and Netflix also weighing on the tech-heavy Nasdaq as well. That's down 174 points or 1.2%. Well, Johnson & Johnson is getting a boost this morning after seeing sales rise 6.3% in the second quarter and raising its full-year guidance. The healthcare giant saw success in its medtech sector in particular, which jumped 12.9% year over year. Johnson & Johnson CFO Joe Wolk joined Julie Hyman and Anjali Kemlani to discuss the results and why medtech saw such a jump.
I would say it's difficult to predict, right? I think folks have been talking about a backlog of surgical procedures ever since the pandemic started to wind down. I would say that what you've heard from insurers, as well as some of our competitors, is that the senior citizens seem to be more willing to and receptive to coming in and getting their clinical procedures done that maybe they put off even after the pandemic had substantially been done. I would say the other thing that's an important factor is just the amazing healthcare workers. There's more stability in the workforce, so procedures are able to be scheduled on a normal cadence. And I think both of those are factoring in well. That certainly did help our earnings and our outlook for medtech, our performance in medtech. But I also wouldn't minimize just the new products we have in that space too that are catalyst to the growth that you're seeing, which we reported this morning. We have a robotic surgery assisted device for knees known as VELYS. We have a catheter known as Q-Dot Micro that is enabling better efficiency for technicians to treat heart arrhythmia in our electrophysiology business. And then just a fantastic new contact lens known as Oasis Max, which enables people who need glasses to see far away and also readers to see close up, the opportunity to have one contact lens to address that all. So there's the market that certainly is a nice tailwind, but it's also the contribution of newer products that we have going on.
Joe, Anjali here. I know that there was so much that drove this boost in the earnings this year, but I did hear a little bit about data and AI, and I wonder what you guys are thinking about in context of that. I know it's really been kind of ubiquitous in the industry for quite some time, and a lot of other companies are sort of taking advantage of the buzz around it to kind of brag. So tell me about how Johnson & Johnson's thinking about that.
Yeah, so Anjali, we've been actually investing in data analytics capability, machine learning, automated intelligence for a number of years now. We're building up that to be a capability with certainly an expertise in the function, but also making it a language that's understood by all of our associates. Where we see the real benefit is hopefully identifying drug candidates, identifying patients that may work on more effectively, and hopefully bringing down the cost of development for either medical surgical procedures or drug development. So that's where we really see the benefit. Obviously, the world is getting smarter with all the information. There's now some medical devices that, let's say, a knee implant has the prospectus down the road of potentially having information, a chip in that knee replacement system to let the orthopedic know how that patient's responding or maybe what's going wrong so that adjustments can be made appropriately. So there's a lot going on. Our robotic platforms for surgeries themselves certainly has a lot of, I'd say, automated intelligence in it. So we're maybe not as pronounced. It's not our bread and butter, so to speak, but we're certainly using it as an enabler to really focus on life-saving medical differentiated innovation.
I mean, and Joe, for you as the numbers guy, saving money is as sexy as any sort of technological innovation.
Absolutely.
So how soon do you expect to sort of see that part of it bearing fruit? In other words, bringing the cost of drug discovery and development down?
Yeah, I think it's going to take a couple years until we really refine the processes around it. I could say, though, Julie, and it is sexy to save money, we've been using this in some of our administrative functions. So some of the accounting functions, some of the HR processes, some of the information system processes in the background, we've already banked, I would say, hundreds of millions of dollars over the last few years by automating a number of these processes. So it's evolving, and I would think that the gains that would happen in drug development down the road certainly might have even more amplification and more benefit to the P&L.
That was Johnson & Johnson CFO Joe Wolk there with Yahoo Finance's Julie Hyman and Anjali Khemlani. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Why aren't we in a recession yet?
So that's a complicated question, but I think there's a big bed of liquidity that the tightening of financial conditions is still kind of chewing its way through. That bed of liquidity was created in the pandemic through fiscal transfers, excess savings, and so the lag effect of monetary policy tightening is taking longer than a typical cycle has.
Analysts are bullish on Netflix, but investors aren't on the same page today as the stock sinks on a weaker than expected outlook. But the streaming giant continued to tout its dedication to revenue acceleration, calling it a, quote, primary objective on its earnings call. Yahoo Finance's Alexandra Canal listened to that call, and she joins us now for a vibe check. Hey, Ali.
Hi, Rochelle. I'm going to get right into it. My vibe check, neutral. Not too hot, but also not too cold. And that's mainly due to what we heard on this earnings call, which talked a lot about the future, right? With revenue initiatives like the password sharing crackdown and the ad tier not fully priced in yet. Netflix executives said it's going to take a few quarters to see the full impact of these initiatives. And I think that's largely what's contributing to the stock declines that we're seeing today. Shares are down another 9% this morning, and that's on top of shares falling 8% yesterday on the heels of that earnings report. Netflix did miss revenue estimates. They also guided to lower Q3 revenue. However, by and large, it was a pretty solid report, especially since some of those profitability metrics like operating margin and free cash flow came in steadily above expectations. And if you think about the media environment that we're in right now with not one, but two strikes in Hollywood, that's a good sign. Ted Sarandos, he's the co-CEO of Netflix. He was immediately asked about the Hollywood double strike on that earnings call last night. Here's more of what he had to say.
So you should know that nobody here, nobody within the AMPTP, and I'm sure nobody at SAG or nobody at the WGA took any of this lightly. But we've got a lot of work to do. There are a handful of complicated issues. We're super committed to getting to an agreement as soon as possible, one that's equitable, and one that enables the industry and everybody in it to move forward into the future.
So Netflix clearly looking for a deal. We've heard from some analysts that say at least in the short term, the strike could actually help Netflix. And in fact, the company did boost its full year outlook for free cash flow to $5 billion. That's up from the prior $3.5 billion, specifically citing the strike. But clearly from Sarandos' comments, it's not something that they want to see continue. And that brings me to my top takeaways from the call, because besides the strike, there was a few other commentary that I want to point out. Also, revenue acceleration. That is the primary objective for this company. It's going to be driven by the password crackdown and the ad tier. But like I said, that is going to take time to mature, and investors are going to have to be patient. And I'll quote Wells Fargo analyst Steve Kehall, who earlier this morning released a note and said, patience is a virtue, especially for those long-term Netflix investors. Another thing I want to point out is M&A. Netflix said it really wants to just keep producing content, not necessarily be a buyer. However, it would consider M&A if it's a strong IP. So a strong intellectual property is what Netflix said could spur some M&A activity there. So overall, neutral on the call, considering we still need time to see how all of this shakes out in terms of those revenue initiatives.
All right, so we've heard from Wall Street. What's the word on Main Street on this, though?
So Main Street, they're very keyed in to the strike. I want to pull up one tweet from a user that said, quote, with all those profits, these streaming services can afford to pay a living wage and provide healthcare to writers and actors. So interesting to see that investors are very aware of the strike and the impact it has on these actors and these writers. We heard from actor Sean Gunn yesterday on the afternoon show. He is well known for his roles in Gilmore Girls, along with Guardians of the Galaxy. And he said companies like Netflix and a lot of those legacy media companies, they're operating on an old model that's not accounting for streaming, especially with residuals being the number one issue that actors are fighting for. And then another tweet that I thought was interesting was calling out the high stock price that we've seen from Netflix over the past few months. This user writing, quote, revenue growth is only 2.7% year over year, similar to all previous earnings since the year 2020 that range between 2 and 5% year over year. This cannot justify the crazy stock price and 50 price to earnings ratio, but still not enough at all for the crazy stock price. So that's just something to call out when it comes to how some of these tech companies have been a bit overheated right now. If we take a look at a 6-month chart for Netflix, that's up about 40%. And then year to date, we're seeing that up even higher, roughly more than 45% there. So clearly a lot of runway here. So perhaps what's happening now in the market is somewhat of a correction. And I also think expectations were really high heading into this print.
Indeed. Well, thank you for breaking all of that down for us, our very own Alexandra Canal there. Well, Netflix came out with its second quarter earnings after the bell on Wednesday. The streaming company saw a beat on earnings per share, coming in at $3.29, but just missed expectations on revenue at $8.19 billion US. Even still, Netflix is still working to differentiate from its competitors and stay on top of the content game. With major difficulties like AI, the Hollywood strikes, and diversification of content, Netflix's future strategy could take many avenues. Quest is the world's largest media and entertainment-focused consulting firm. Let's bring in Quest US EVP of Digital Supply Chain, John Christian, to dig into what may be Netflix's trajectory going forward. Good to have you on the show here. So, obviously we've come a long way from where Netflix first started, when the competition was not this fierce. What is going to be the key then? What is going to be the key value add or differentiator for Netflix at this point of the industry?
Well, I think you kind of hit the nail on the head. So Netflix originally differentiated with their technology platform. They were basically the first in the game in streaming. They were cloud enabled. And the other advantage that Netflix has over the others is they haven't done a lot of acquisitions. And as a result, they are literally going off of a single media supply chain. And there's a ton of efficiencies that could come off that. So from a cost perspective, I see that Netflix is definitely going to dive deeper into the technology. There will be a ton of automation on the AI side when it comes to localization and globalization. And I think where Netflix also has a strong differentiator is in their global model. So traditional content creators are creating content in the US and then localizing it internationally, where Netflix is doing a ton of in-territory content creation. And I think that could actually pay off pretty well. And especially with the impending strikes, leveraging the content from international territories and bringing that into the US also could pay dividends.
And you raise a good point, because with the double strike going on at the moment, when you look at other markets that have really been a boon for Netflix, you look at some of the Korean language content, we have content coming out of India, Nigeria, Nollywood content as well. How much room is there to grow for Netflix in those markets?
Oh, I think quite a bit. And not only, so obviously the in-territory content, it's a great boon for basically that territory, because they actually want to see local talent, not just be dependent on actors from Hollywood. But I think the surprise to many was how well it was received in the US market, right? If you just even look at the success of Squid Games and things of that nature, I think there's quite a bit of room. And I think you're going to see the other studios and content creators, they're actually going after that same type of market too.
And we've seen a lot of consolidation in this space, a lot of, movie companies and streamers trying to figure out about putting some of these releases in movie theaters versus how long they should keep them as actual just streaming products and services there. What is the gameplay here in terms of what will give them the best bang for their buck, and how they should be thinking about the types of content that they do put out in movie theaters?
Yes. So I think first of all is, I think if you look at the past 2 years, it was get subscribers at all costs and create content at all costs. And I think some of the quality was sacrificed as a result in being able to do that. In this particular case, in terms of creation of the content, and I'm sorry, just one more time, would you mind just reminding me the question?
Sure. When you look at where some of these streamers are getting the most bang for their buck, and they're thinking of theatrical releases versus keeping them as, a series on the platforms.
Thank you. So sorry. So Netflix has been very against theatrical release because they wanted to be a technology platform, and everything was about putting it on the platform. You look at the other traditional studios, what's amazing about what they do is when they create a theatrical release, they're able to recapture all of that cost in the theatrical market, or at least a good portion of that, and not even release it to the streaming platform for a period of time. They have a release window, right? And being able to do that. So I really do think that Netflix should think long and hard that if they are going to create theatrical release, feature release, non-episodic content, that they should have a strategy to go to the theaters that at least will allow them to recoup some of their costs and even potentially have a higher revenue. And that makes them more of a traditional kind of studio. And I know they want to stay on the technology platform, but I think that's a much better route to go than trying to diversify into gaming or something like that.
And as they do focus on quality versus quantity, we keep hearing about the next stage perhaps being sports, but very expensive for some of these live sports broadcasting. Is that something that you think is going to pay off for Netflix at this point?
So let's talk about what they have done in sports. I mean, so if you look at what they've done with Formula One, what they've done with golf, what they've done with tennis, it's not live, but they're doing documentary style content delivery. And in being able to do that, they are creating a connection with the fans to basically those particular athletes or personas. And you're feeling very close. Just look at how much F1 has taken off in the US in the recent years. And I think a lot of that is owed to basically Netflix and being able to do that. So people that weren't even watching F1 before are now attached to drivers, understand the different car makers and basically how it works. And now they're attending live events in Austin and Miami and things like that. And so what they're able to do, and they also have a very rich data analytics platform, they could see how well this is being received. That could give them very informed decisions on if they actually want to get into the market and go into live streaming of sports content. So I do think that is an uncharted territory that could have major dividends for them if they want to get into that game.
Definitely want to see where that goes. The documentaries have been fantastic, so it definitely makes sense that would be the next natural evolution. A big thank you there to Quest US EVP of Digital Supply Chain, John Christian. Thank you for your time this morning.
Thank you so much. Appreciate it.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Are stocks going to be higher or lower at the end of earnings season?
We think probably lower. You're still going to have earnings disappointment. The quarter's projected to be down, so prices have disappointed when earnings don't meet expectations.
The fight between UPS and the Teamsters Union is still ongoing, with the contract set to expire on July 31st, giving the two sides 12 days to negotiate a new deal. Now, if a contract is not signed, our next guest says the impending strike could lead the economy in a, quote, disastrous direction. Let's bring in CNBC founder, Target Media chairman and CEO, and Newsweek editor-at-large, Tom Rogers, to discuss more. Thank you so much for joining us this morning, Tom. So talk about the tipping point that's really at stake here with this standoff between UPS and the Teamsters Union.
Well, this is a very touchy issue because we are teetering now in terms of the economy. Are we going to go into recession? Or are we going to have a soft landing? Chances for the soft landing have clearly improved. Inflation seems to be being tamed decently. But the big thing that the Fed obviously has its eyes on is wage increases. And the pace of wage increases at 4.2% last is something that is still considered too high, and the thing that is most likely to trigger more rate increases. So now we have this thorny labor dispute where the Teamsters and the UPS, Teamsters probably being the most powerful labor union in the country, and about a third of their members working at UPS. UPS is a huge backbone of the economy. They deliver about 20 million ground packages a day, 25% of all of that ground package delivery, something of the scale that FedEx and Amazon just aren't going to be able to absorb if that goes away. Obviously, that's going to have a hugely damaging effect on the retail sector and the high growth sector of e-commerce only companies, obviously being totally reliant on this kind of delivery. So all of that is pretty high stakes stuff in terms of consumer impact. But, you know, beyond the impact on the economy and beyond the impact on consumers, this is really something that, in terms of the Biden reelection and Bidenomics, is a very, very touchy issue. But this is just not a typical labor dispute. The UPS workers at Teamsters Union are very highly paid. The average full-time driver makes about $95,000 a year. The more senior tractor trailer drivers make about $165,000 a year. That's with no cost health insurance and about $50,000 a year of pension and other benefits. So the real issue comes down to the part-time workers at UPS, and this is where the union is focused. These are $20 an hour workers. There's been a substantial increase through COVID in the number of part-time workers. These are people who choose to work 15, 20 hours a week. And the union is seeking something like a 35% increase in their hourly wage. Now, with a Fed focused at a 4.2% wage increase still being too much by way of inflationary pressure, that is really a knock the socks off issue and could really contribute significantly to pressures on the economy, particularly if it's a precedent for other union negotiations. And those part-time workers, I might add, get also no cost health benefits. And actually, as part-time workers, which is very, very rare, get pension contributions as well. So that's the backdrop against which this is playing out. But the politics are very intense. First of all, the administration has no labor secretary right now because the nominee for labor secretary can't get a hearing in the Senate. And you need a behind-the-scenes hand here, no doubt. And the Teamsters don't really want the White House to get involved here. And the Teamsters is extremely supportive of President Biden, and very likely that they'll come out and fully endorse them, even though they've been very supportive of him and his reelection without a formal endorsement. But the Teamsters have their own politics. They're getting pushed from the left to call a strike, and that's creating a very, very difficult political situation.
So, Tom, is there a viable path through this then, especially given the delicate position that President Biden would be in?
Well, one would certainly hope so. I think cooler heads are going to have to prevail. somehow the parties are going to have to get back to the bargaining table. What's very peculiar here is if the union strikes, they are going to send some of that $170 million a day of UPS business that goes up in the air to FedEx and Amazon, both of which are non-union shops. So the union would be sending all kinds of business to non-union shops. This isn't like the writer's strike or the actor's strike, where the entire industry is hurt by what is going on here. Here, if there is a strike, the other major industry players benefit, which is to the detriment of the union. I have no doubt that UPS will give some form of meaningful wage increase here. The issue is the push by the union for something that really would contribute to major inflationary pressures. And the White House is going to have to, in some way, insert itself, even against the union wishes, that it not get involved. Because if this does go to a strike, and it really is a push for those kind of wage increases, not to mention the strike impact on consumers, this is just not good for the Biden economy and for the Biden perception of strength among consumers going into an election year.
So for investors and private companies also that are looking at this situation and thinking, what are the opportunities here to either perhaps push talks forward or have more of a say when you look at this, especially things like wage increases? What role could some of them play?
Well, I think that you have to have everybody beginning to think through what makes the most sense for union members. A Biden re-election certainly makes sense, and jeopardizing that would be silly. Throwing business to non-union companies doesn't make a lot of sense for a union job action as well. I think the idea of lowering the perception of UPS workers by striking in terms of the amount of disruption throughout the retail sector and e-commerce and the 20 million a day of packages. So I think all the forces that the Teamsters interacts with in the political landscape that can understand what a reasonable settlement is here that avoids a strike, which just isn't good for the union at all because of all those reasons. Those forces need to, behind the scenes, help push this along to a more reasonable settlement.
And certainly economically a lot at stake, as you broke down there for us. A big thank you there to Tom Rogers, CNBC founder, Target Media chairman and CEO, and Newsweek editor-at-large. Thank you for your time this morning.
Thanks for having me.
Taking a look at Tesla shares slumping after a disappointing earnings call hinted at further price cuts and higher spending in the months ahead. Margins below expectations were the big concern, with operating income of $2.4 billion missing the street by a distance. CEO Elon Musk says Tesla will have to keep dropping prices if rates continue to rise. Let's get the overview of the wider auto industry with Jill Malandrino at the Nasdaq. Hey, Jill.
Hey, how's it going? In April, the EPA announced new emission requirements aimed at having 67% of cars sold in the U.S. with zero tailpipe emissions by 2032. About a year and a half ago, the Biden administration said it wanted 50% to meet that mark by 2030. It's one thing to want an outcome under the proposal. The EPA estimates 50% of new vocational vehicles like buses and garbage trucks could be part of this program by 2032, along with 35% of new short-haul freight tractors and 25% of new long-haul freight tractors. So that's a pretty aggressive mandate, and there's a lot of work to do in this space.
Indeed. So then, Jill, what are the other challenges associated with electric cars and truck manufacturing mandates?
An incomplete charging infrastructure, what happens if you run out of fuel on the road? No one can bring you a spare battery pack. There's also cost, availability, and supply chain risks of raw materials. Car makers will need more minerals to build more batteries for more EVs. It's no secret that China has established a dominant position in battery manufacturing, but that commanding position extends down through the battery supply chain, whether in rare earths mined and processed at home or in sourcing additional raw materials from other countries.
So then, Jill, what are the biggest issues to making mass adoption a reality? I know we keep talking about it, about what the tipping point will actually be.
Well, it's interesting. Tree Hugger, a publication that analyzes sustainability solutions, points out that just over half of the cost, about 51%, of an electric vehicle is in the powertrain. That includes battery, motors, and their associated electronics. By contrast, a combustion engine in a conventional vehicle constitutes roughly 20% of the total vehicle cost. Now, innovations in battery chemistry are leading to EV cost declines, allowing EV makers to reduce the price of their vehicles. In the United States, as a larger high-speed charging network assures EV owners that they will be able to charge their vehicles on road trips, that will allow EV makers to face less pressure to build ever bigger batteries with an ever greater range as the efficiency of those batteries continue to increase while their price continues to decline. Batteries can be smaller in size but still provide the same range, lowering the overall cost of the car if we get that infrastructure in place in the U.S.
Certainly a big if, but thank you for getting us up to speed. Jill Malandrino, thank you so much. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Are you planning to watch the Women's World Cup, which is coming up?
I'm excited for it. I think it's got more energy around it and more viewership than we've seen in a long time, probably ever, frankly. So I think it'll be exciting. I think the U.S. is going to do well, surprisingly.
According to Bloomberg, Apple is entering the generative AI race to hold its own against its competitors. The push into AI has reportedly seen a lot of initiative for the past several months. While the details remain unknown, let's turn to Yahoo Finance's Dan Howley to see what light he can shed on the news. Hey, Dan.
That's right. We have a report from Bloomberg, as you said. This is from Mark Gurman, who is living inside Tim Cook's head, I think. And basically what this says is that Apple is in the generative AI space, in the early stages at least, basically putting together its own take on generative AI. They have the foundation for it so far. That's something called AJAX. And what they're doing is trying to figure out what to do with it. The report says that they have a kind of ChatGPT style piece of software that they were using internally with Apple, though it's not for consumers. And they don't know where this would kind of slot in to their overall product offerings. You know, this is a company that tries to make the technology part of things fall into the background. So they rarely talk about speeds and specs. I mean, even when they do with their processors, they don't go over, you know, gigahertz or anything like that. They just show a graph and some lines, really kind of no numbers on it. So they don't like to get that nitty gritty into the weeds. And I don't know if we would see any kind of announcement about a product like this, maybe just something that would fall into the background of existing technologies that we already have, maps, things like that.
You know, Apple does play it close to the chest until they go and fully announce something, so we'll be keeping track of that. A big thank you there to our very own Dan Howley for that breakdown. Well, that does it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern tomorrow. I'll see you then. Grazie.